exactly what he means, but if you talk about regime change at the Fed, there's a lot of things that you have a problem with other than just who the current Fed chair is. It's sort of a systemic issue that I think he has about transparency as well. You know, every waking thought coming from the Fed and dot plots and all those things. I think he'd like to change that a little bit too, Steve, right?
I think that's right. You know, some of the things that Warsh has said make a lot of sense, and some people puzzle over some of these things, I have to say. When I talk to other people who are, I guess, maybe part of the current regime, they're a little puzzled by some of the comments that Warsh makes. And there's some questions about exactly what he'll do. I mean, what he has is this notion, and this is out there as a conservative critique, I guess, right now. Maybe it's more from the Trump side than it is the conservative side, that if growth is high, that the Fed raises rates. That's not actually accurate. The Fed raises rates, looks at growth as relative to potential and says there's a risk there of inflation. But it's really hard to find a situation where the Fed has really cut off growth too dramatically by raising rates in the face of strong growth that wasn't accompanied by inflation.
We think about that every single time it's the good news, bad news. We always talk about it. Uh-oh. Something comes out, it's either a good jobs number or a hot GDP number, or it doesn't have to be inflation, and we'll say, uh-oh, the market's down because now they think that future rate cuts are in jeopardy because the economy's running hot. That's the whole nature of what we think.
But the weird thing, Joe,
but we think about that all the time, and maybe it's not true.
Absolutely right.
And we don't.
Absolutely right.
Why should we always think, uh-oh, we need to slow the economy down? If there's productivity and there's no inflation, it's like, let it ride, baby. And actually, Besson has said they want someone like that. The president is innovative. Someone like Greenspan back in the 90s.
What about a market melt-up? That's the
Wait, Joe. What is the actual?
That's the same thing.
What were the actual instances of that? And hasn't the conservative critique of the Fed been that the Fed is too easy? That has been the running critique of the Federal Reserve for decades. And when I think back on the situations that you were talking about, you're right. The market does get concerned about that. But the real actions of the Fed, as at least critique from the right, have been that the Fed is too easy. Think about, you know, it raised rates in 99. Was that wrong? That was, you know, and he let them ride in 96. Go back through the decades, Joe, and it's hard to find a case where the Fed said, well, because of high growth, we're raising rates. It does so when inflation ticks up.
Right. Steve, let me ask you this. Because Kevin Warsh has been so critical of the Fed for so long, I know there are some people inside the Federal Reserve right now who are not huge fans. What's the relationship going to be like with him coming in? And I ask that specifically because the chairman of the Fed is not necessarily handed a mandate to be able to determine how the FOMC will vote on any given day. Will he be able to come in and build a consensus to say, here's what I think, and that's why I'm going to convince the rest of you that this is what we're doing?
You know, Becky, what you're just pointed to is essentially the Federal Reserve Chair's job, right? Congress creates this Federal Reserve that has representatives from districts all through the country. And I'll get to the staff in a second. That's a separate order because Warsh has criticized staff. He's criticized the PhD. He's criticized the elite running policy. And he also has said that policy has been favoring the wealthy rather than people. And I think rightly so when it comes to criticizing, by the way, the Fed's actions during the pandemic. But he's going to have to put a consensus together. And by the way, that's one of the things that, at least in our Fed survey, is something that makes people a little less concerned about whoever this chair is going to be, is that the committee is still there. He still needs the committee. He has to work with them. Now, the Fed chair has a lot of sway over the committee, especially the Board of Governors typically. But there's going to be people like, you know, you think about the tradition at Kansas City, which has been, you know, leaning against lower rates for a very long time, back through many presidents. We have Esther George on all the time, Tom Honig, and now Alberto Musalem, who's in there, has been somewhat hawkish. That's St. Louis. Jeff Schmidt from Kansas City has dissented several times. So Fed Chair Becky's going to have to put the together. He's going to have to work with the staff. But you can imagine, you're right. There are people who who disagree with Powell, with Warsh's ideas, especially about QE, and they think that Warsh was wrong, essentially, in the wake of the great financial crisis about his concern about inflation when it came to
Steve,
QE.
Don't we need, with as much hand-wringing and pearl-clutching as there was from Fed watchers about the independence of the Fed, don't we at least need to give Trump some credit that has not, at least this is an indication that he's not putting in a rubber stamp for lower rates? If he had picked Hassett, that's the first thing that it would have been splayed across every newspaper in the land, that the independence of the Fed is gone because he put one of his cronies in. So can we at least...
Yep.
I'm not singling you out specifically, but can't we just say for Fed watchers that had hair and that was on fire, that the worst did not come to pass?
Were you making an anti-Baldite comment there, Joe? That's okay. I'll let that one go.
It was not anti-Baldite. I'm not an anti-Baldite because I've accused of it a lot.
I think you are.
I feel for follically challenged individuals. I feel your pain.
I'm not challenged, Joe. I'm happy and proud about it. Okay. It's maybe my.
I've asked you to shave it completely. So you'd look like a total badass.
My most redeeming feature, and I'm sure our producers don't want us talking about this because I will answer your question. I like your Churchill analogy, and I do need to point out that it was sort of market resistance and Wall Street resistance to Hassett.
I agree.
That caused the president to change his mind. So
trial balloons.
Yeah,
trial balloons were not good.
Nobody. Let me give the president and Treasury credit in the following way. This was a very public and transparent process. We were able to have several scoops on what was going on. We're not the only ones. We understood what was going on. These things were out there, and the president got a view of what was happening. I think perhaps the criminal investigation of Powell played a role in some of this. But in terms of finding somebody who I think the market can count on to be independent, I don't think that Kevin Warsh is going to preside over runaway inflation in this economy. And I think that there is room for the Federal Reserve to be tighter with its policy. I think the Federal Reserve, and I think Powell has acknowledged this, was wrong to hang on to QE as long as it did in the wake of the pandemic. I think that was a problem. I don't think the rate thing is more of a debatable issue right there. So I don't think that we have abiding concern right now with Kevin Warsh being the nominee about independence of the Federal Reserve.
Great. He's got great hair. Not that Jay Powell has pretty darn good hair for his, but problem. You have good hair.
Steve, you're amazing and we love you. You're an incredible reporter and you're hot.
He's very, very hot. But
People say I shouldn't wear a hat because it covers up my most important feature.
Get rid of this. Get rid of this, and you will. I'm telling you, you will be a babe magnet. Get rid of that. Not that you. I'm only
on TV because I have to be to report. Otherwise, I'm better on radio. I'm sure.
All right. Checking the futures. Thank you, Steve Lee.
Thank you, Steve. You're amazing.
Anti-Baldite. You remember that? That was a good. They went to meetings. George did. Yeah, Costanza. Can't stand you. Checking the futures this morning, you can see that they have they've improved maybe just a little bit from where they were. I think that was the knee-jerk reaction to not getting a more dovish Fed chair. But there's a lot of things obviously going on in the world right now. It's hard to ever say what on any given day.
That's pretty massive improvement.
Yeah,
we
it
were
has
down
gotten a lot better.
330 plus points just an hour ago.
And
by the way, the 2-year yield has now moved lower. It was higher.
10 years behaved. Take a quick look at the dollar, then we'll get to Dom Chu, who has a look at this morning.
I just want to see gold real quickly, too.
Pre-market movers, yeah, gold was actually
down by more than 4% earlier.
Yep, silver. Yeah. How do you explain that, Dom? Silver. I've given up.
I think a lot of people have, especially with the kind of parabolic moves that we've seen just over the course of the past maybe week and a half in silver especially. But, with that kind of a move, maybe a 4% pullback isn't out of the realm of reason, I guess, in that kind of a mode. But to your point about the kind of multiple catalysts, Joe, Becky, right, that are kind of moving things around, the Fed pick, Warsh is certainly one of them. We saw movements there based upon the social media post from the president. But we're going to take you through some of the other reasons why markets are gyrating around the way that they are right now, predominantly to the downside for the most part in some of those tech trades. But it has to do with a lot of these individual movers that are setting the tone for what's happening. So we're going to start with shares of SanDisk, which are actually bucking the trend right now, soaring by about 23% after its second quarter results blew past Wall Street expectations. The data storage company said despite pulling in over $3 billion in revenue during the quarter, the company was still unable to meet demand for all of its products, and it expects demand will continue to outpace supply throughout the course of the year. So that bullish commentary and the results helping to pump SanDisk up 22%. Now, Visa shares right now are dropping by just about 1.25%, despite a fiscal first quarter beat. The company said payments surged 8% from a year ago amid strong holiday spending. Visa and its competitors have been under pressure after President Trump called in a one-year 10% cap on credit card interest rates. Those shares right now just down about 4.5% over the course of a one-year period. And then shares of Deckers Outdoor gaining just about maybe 13% as the maker of shoe brands like Uggs, Hoka, and Teva beat estimates. The company also issued fiscal 2026 guidance above expectations. Net sales for the Hoka brand, by the way, jumped 10% during the quarter to over $600 million. It's become a real cornerstone for those brands. Now, with regard to the big tech trade, software, of course, big tech, a big part of the market story in just the last couple of days. Microsoft reported that surge in spending, maybe perhaps punished for it. Investors also wanted more from the cloud business there, Azure. That stock is flat, maybe-ish this morning, just about 0.5% gain, but it was 10% down yesterday since that Wednesday report. Meta spent on CapEx and was actually rewarded for it. Those shares are maybe right now down about 1.75%, but 8% up since its report. Now, software troubles go beyond Microsoft this week, though. The IGV, which is one of the big ETFs that tracks that sector, is down roughly 13% in just the past couple of weeks, and just through today, down about 6.5% from the end of probably the 28th there as well. So keep an eye on the IGV, software, cloud computing overall, guys. It's become a big part of that market narrative, Becky. I'll send things back over to you guys, Joe.
All right, Tom. Thank you.
You got it.
All right.
When we come back, American Express just out with earnings. We've got some insight on the consumer, and we will cover that for you next. You can see the stock right now is off by about 0.8%. 355.55 is the last trade. We'll tell you all about the earnings and what the CFO is saying. We'll be right back.
UGC बिल वापस लेना होगा।
full-year earnings guidance was above what Wall Street was expecting, too. They're saying that they see $17.30 to $17.90. The consensus was only at $17.41. And I spoke with the CFO, Christoph Lakayak, about this. That same story is continuing that we've seen for many quarters now, just where high-end consumers are really doing pretty well. That tale of two cities that we've talked about, or tale of two economies that we've talked about, high end is doing well, and American Express tends to skew to the high end. I asked him about that. He said, yeah, since we over-index on premium cards, the front of the cabin is full, luxury spending is up. Clearly, we're riding that wave. A strong consumer on the high end of things. Run through a couple of these numbers. Billing up by 8%. Travel and entertainment was strong. Retail was strong. Luxury spending was up by 15%. Restaurant spend was up by 9%. International spend was up by 12%. And their travel agency, this is an interesting AI aspect of things right here. They said typically the fourth quarter is not as strong for their travel agency, but bookings were up 30% in the fourth quarter. He attributed that to a new travel app that was introduced in September. He said the old experience wasn't great. The new experience is much better, but they are using AI to make offers and things, and that is making an impact. The average age of a new Platinum card member is now 33 years old. They have not disclosed these numbers in the past. They are now, just to kind of show off how young they are. They wouldn't give me a comparison age of what it was before, but for a new Platinum card member, 33 years old. For a new Gold card member, just 29 years old. And those have been the two things that American Express has really played so well. The idea that they are that they are giving their cards to people who have more money. The high-end consumers have done better. And they are also getting younger consumers, and that's pretty important, too, just in terms of the spend and the life of the consumer that you will see. Stock right now is down by about 0.7%. Over the last year, though, it's up by 11.6%, and they have pointed to what they have done just over the last few years in revenue and earnings per share. Revenue from fiscal year 2022 was $52.9 billion. Now it's $72.2 billion. So you've seen some huge growth there. Earnings per share have gone from $9.85 over that period of time to $15.38. And that's a CAGR of 16%. So they are a company that has done very well. And if you look at the stock's performance over the last few years, you can see that.
It sure has. Before we head to break, though, here's a look at precious metals. We were talking about that after President Trump announced Kevin Warsh as his pick to be the next Fed chair. You can see gold down 3%, silver 9% sounds like a lot, but I can't even. I have no comment. $103 for an ounce of silver, ridiculous. I'm looking through all my old.
You're gonna melt all your.
I'm looking through all my old. The things we collect the change to bring, and you usually give it to try and get paper money. I'm looking for quarters, real ones. Much more on Warsh throughout the morning. Squawk Box will be right back.
The requesting.
पूरी करो यूजीसी बिल वापस लेना होगा
2022. So what they're proposing is a 9.9% tax rate on those making $1 million or more. Virginia, with that new Democratic governor, they're considering bills to hike the top rate from 5.75 to 10%, so a big jump there. That would just be on those making more than $1 million. That comes as many of Virginia's neighbors, meanwhile, are cutting or eliminating their state income taxes. Then in Michigan, you've got a proposed Invest in Michigan Kids bill that would raise revenue for education with a new rate of 9.25% on single filers making more than $500K or joint making more than $1 million. Then you've got Rhode Island, which last year passed that special tax on expensive vacation homes that was called the Taylor Swift tax. They're now looking to raise the top rate from 5.9 to 8.9%. Some say these increases will accelerate wealth migration from blue to red states. We've already seen a lot of that. But proponents point to Massachusetts' Fair Share Amendment that added 4% to those making more than $1 million. It passed in 2022. It has raised $5.7 billion in its first 2 years. That was about twice the original estimate. So a lot of people pointing to that, saying, see, this is proof they don't leave. Now, for a full breakdown on what states are doing to tax the wealthy and what it could mean for wealth migration, you can sign up for the Inside Wealth newsletter at cnbc.com/insidewealth.
Okay, here's my question. The Massachusetts law is interesting. People of making $1 million are far less likely to leave than billionaires, because if you've got $1 million or $2 million job, you're not going anywhere.
100%.
You lose your job. I wonder what the impact is on Washington State after what they passed, because I believe both Bill Gates and Jeff Bezos. Jeff Bezos definitely left.
Definitely left.
I don't know about Bill Gates, but it wouldn't surprise me if he has redomiciled too. What does just losing those two people mean for Washington State, especially for an estate tax?
Yeah,
or for like a death tax.
I mean, there is a big tech community, probably a lot of seven-figure earners there, and I think the big question there is, you know, whether it survives the constitutional challenge, because they've never had a state income tax, and everyone warned, look, if you get this Seattle tax and the court approves it in the state, they're going to go with an income tax. And the proponents will say, no, we're not going to do that. And of course, we're seeing that. And now that tech is relocating everywhere, I mean, you've got a big tech community in Texas, you've got tech communities in Tennessee and Florida, in Miami. Yeah. So I think it may not affect the existing tech base in Seattle, but if you're starting a company now and you're figuring out where to go, where are you going to go? You're probably not going to go to Washington State. Again, you're probably not going to go to California.
Those highest earners, those wealthiest people, if they move and leave a state, it can impact the state's budget.
You're right. And we saw that
it happened with David Tepper in
New Jersey.
One guy leaves, and it affects the state's budget.
And the proponents say, well, you focus on a couple of high-profile investors.
Good reason.
And whereas in New York, as Mamdani rightly told Andrew Ross Sorkin, the number of millionaires in New York has continued to grow. But it's far underpaced the rest of the country. Millionaire growth in the rest of the country is much faster.
That's interesting. I haven't
much faster. So yes, it's grown, but not as fast as the rest of the country.
I'm thinking Texas now. I was in Florida.
You thinking of going to Texas?
Thinking Texas. If I ever had to win anything. I mean,
Wait,
Florida's got
you
no
changed your mind about Florida because you spent some time there?
Well, let's see. It's 40 degrees in the morning, and you know what my real problem with Florida is?
Yeah.
The traffic lights.
Traffic is bad.
The traffic lights. I was like, they last 5 minutes. They last 5 minutes, and then there's another one.
You're going nowhere.
I'm not going to Florida.
I
am not going to Florida.
Spend some time
maybe Georgia needs to get rid of the state income tax.
You've got. If
Florida is off of my list.
Florida's off your list because of the traffic light?
Yep.
Robert, thank you.
Thank you, guys.
Great to see you.
Coming up, shares of SoFi on the rise. After earnings, Anthony Noto, the CEO, is going to join us. We'll be right back.
पूरी करो यूजीसी बिल वापस लेना होगा
We're going to check out the stocks. The shares of Starbucks jumped after earnings on Wednesday. However, it gave back those gains, now down about 4% on the week.
All right, fintech company SoFi just out with its fourth quarter results, coming in at 13 cents a share. That compares to the 12 cents the street was expecting. Revenue also beating at $1.01 billion versus the $985 million that the street was looking for. And joining us right now is Anthony Noto. He is SoFi's CEO. Anthony, just tell us a little bit about the quarter. Numbers did come in a little better than had been expected. Why?
Sure. It ended an incredible year for SoFi. In the quarter, we had 37% revenue growth, 35% member growth, and 37% product growth, with really strong margins at 29%, and our EBITDA increased 60% year over year. Overall, we've been driving more than 30% revenue growth each quarter throughout the year, and as we go into 2026, things look incredibly strong and guided the first quarter to 35% year-over-year revenue growth and the full year at 30%. It really reflects the innovation that we're driving, the number of new products that we're building, as well as the increased awareness through our branding efforts. So all cylinders are hitting very strongly right now, and it's coming out with these results. It's really unprecedented, 37% revenue growth with 29% margins.
Yeah, Anthony, over the last year, your stock has performed remarkably well. It's up by about 55% over the last year. But if you look at it for the year to date, it's down. And there are several.
पूरी करो यूजीसी बिल वापस लेना होगा
Ladies and gentlemen, the budget marathon continues. I mean, for those of you who tune into us on CNBC TV 18, we've been doing this for 26 years. I've been doing it for 26 years, and these two gentlemen have been part of our budget programming for many years. So thank you very much, Mr. Jory, and to Mr. Ranjan for joining us here. Now, let's come down to the nuts and bolts. You know, a lot of the conversation that we've had in the last few sessions has been more about what the government can do in terms of intent, signal, direction. Let's talk about numbers. And Mr. Ranjan, let me start by asking you, on the direct tax side, we already saw the last budget make changes as far as the income tax side was concerned, providing the much needed, much wanted relief. Do you expect more this time around?
Well, Srina, I think a lot has been done last year. I mean, much more than expectations. There was a 1 lakh crore shortfall which was factored into the budget estimates on account of those changes in personal income tax. But then I think now the situation that we see, if you look at the figures for the current year, it seems that there's going to be a further shortfall primarily on personal income tax, which could be in the region of 75,000 crores or more.
So that's a big hole that we're talking about.
Right.
That's a big hole we're talking about.
Yeah, yes, it is a big hole, certainly. And but also worrying is that the buoyancy in personal income tax collections, which was estimated at about 1.4 in the last budget, I think we can't hope for more than 1.1 in this current year, and which only indicates how well it can do in the future. Can we really hope for a higher buoyancy or a nominal GDP growth of 10%? As expected. So I think the space for giving further tax giveaways is very small. But then that doesn't mean, of course, that there should not be reforms. There are many distortions which can be corrected. Much more simplification can be done. There is a lot of talk about the two regimes in personal income tax. I think it's high time the government really thought about having just one regime. Maybe with a few more incentives like house rent allowance and pension scheme thrown into the new regime.
Mr. Jory, let me address the issue of customs duty rationalization, because evidence at this point in time suggests that the budget is going to take that forward. We saw that being mentioned by the economic survey as well. Now, how far and deep do you anticipate that rationalization, especially given the fact that we are now opening up, so to speak, to the world?
Thanks, Shireen. I think that is something that we can quite reasonably expect would happen in this budget. We are down to about 8 rates, not counting outliers. I mean, actually, there are outlying rates like 40, 70 and all, which I'm not taking into this reckoning. But 8 is a large number, and it's accepted wisdom in tax policy that the larger the number of rates, more the arbitrage, more disputes. We've come down from 21 in 22, 23. And I think there's an opportunity also because, and this is one of the positives of the position of the rupee. So with the depreciation of the rupee, I think there is some cushion available to the government to drop customs duty rates. So I expect 2 things to happen. There would be moderation of rates. And my expectation is that the rates would come down to 4.
8 to 4.
8 to 4, the number of rates. And if you recall, for a large number of years, we lived with that structure, and I think it worked well. Of course, it was graded. There is a school of thought that you need not get into a complex structure like that, and there is room to compress it even further. If that has to happen, I think it will happen in a phased manner, may not happen immediately. The problem also is that you have to balance this with the need for shoring up manufacturing.
Yeah.
And to what extent a manufacturing sector is able to absorb the reduced rates and to live with them is also an issue, particularly when you're getting into FTAs. So my take on it is that there would be a compression, I think reasonable to expect come down to 4 rates. There may be some sectors deserving attention, where it may be a good idea to announce a glide path.
Okay.
And if these are priority sectors, maybe the government could announce that there'll be enhanced rates for the next 2 or 3 years or 4 years, whatever is the plan that they worked out with industry. And after that, the rates will start coming down.
More items under a cess bracket, new cesses, anything likely on that front, you think?
I think we already have a couple of cesses. So I don't think this is the time to introduce new cesses. At least I would not expect them personally, because they just complicate the rate structure. And I would just like to comment on your question about certainty. I think even in indirect taxes, that's a very big concern. And that's something that speaks directly to investors, whether it's direct tax or indirect tax. It's easy in our system to raise disputes, but very difficult to close them. And there are mechanisms available to deal with that. We have advanced ruling on the customs side. Ever since we decentralized advanced ruling, I think it's worked very well. I think we need to broaden that and bring in more advanced ruling authorities, at all the major ports, and maybe even allow, the commissioners, the chief commissioners of the port themselves to issue rulings, because then they're easily accessible. That's one. And then, we have to be very proactive in ensuring that taxpayers are treated alike, and, there are no surprises that are sprung on them. So I have 2 or 3 suggestions there. We have what are known as national assessment committees, which are chaired by chief commissioners. And they've been assigned different commodity groups to, examine. I think they should go out proactively. We have all the data we want to be able to figure out whether the same product is being treated alike at different ports and, different formations. And if they're not being assessed alike, then what are the reasons? And, they're the ones who should go out proactively explore that. And before it converts into an investigation or, a show cause notice, these are senior people who should apply their minds to it and maybe recommend to the board to issue circulars where it's warranted. There are powers in law to do that. So I think that's one way of dealing with uncertainty and doing away with surprises. Also, there needs to be greater consultation with industry. I think it speaks to the point which Mr. Akhilesh Ranjan also raised. With new technology, I mean, our officers are really not all the time equipped to handle assessments and classification, etc. So it's a good idea to set up advisory committees, at least for these high-tech industries, where we can talk to industry experts and figure out, how best they should be classified in the tariff, what their tax treatment should be. So I think there are ways available out there to ensure more certainty in the system. But that's, I think, very badly needed.
Very badly needed, and some suggestions that you've put on the table. On LTCG, and again, the clamor from the stock markets is loud. Roll it back altogether. Do you believe that that is warranted at this point in time?
Well, yes, I do have my views on that, and I don't think government circles might like those views. I believe that the STT must go. It is high time it should go because, let me explain that. We brought it in 2004 as a substitute for long-term capital gains tax on equities. We reintroduced long-term capital gains tax on equity in 2018. Yeah. 2 years back, we enhanced the rate of tax out there. Now what we have is a situation where the long-term capital gains taxes are substantial, are fairly of a large amount. There doesn't seem to be any legitimacy remaining in continuing
STT.
with the STT any longer because the rationale has completely disappeared. Now, there is a problem because of revenue hit. It will be 60,000 crores or 70,000 crores on that account if you remove it. But that's where I say that we have to think about alternate measures, and I keep going back to that 13 lakh crore blocked in litigation, which has to be addressed. We have to find ways of getting that revenue. But yes, STT doesn't really, is not justified any longer.
Okay, STT no longer justified. What else do you think is past its expiry date that needs to be axed?
You mean in terms of capital gains or?
On the direct tax side.
Oh, yes, I think there are other areas. There are there are gaps which have not been addressed. For example, the taxation of services. Now, you have presumptive schemes of taxation, which is a very good measure, simplifying the law and simplifying compliance. There is presumptive tax for the small traders. There is a presumptive tax for professionals like architects and doctors. But there is a whole range of service providers in between that doesn't really have a dedicated presumptive tax regime. They try to fall within that small trader regime, which is in fact which is where the government is losing because the tax is very less out there. But I think we must address the taxation of services being a very large component of the economy, and not just domestically but also internationally. I think that's an area.
Present. When the market moves, we don't just report, we decode.
From the boardroom to the trading floor, we track what's driving business and impacting investor sentiment.
With insight that empowers and guidance that builds wealth.
Nuvama presents CNBC TV 18 Market Central.
For your daily source of market intelligence and wealth creation, with a commitment to doing it right.
My bhai, do you know any cool bank जो digital first हो?
SBI coolest है.
What?
Digital loans 30 मिनट में. AI models 140 plus. Yono users 9 crore. Daily UPI transactions 33 crore.
Cool तो है.
चलो. SBI, the banker to every Indian. Truly.
CNBC TV 18 tracks the pulse of markets and business in real time, bringing you the stories that shape the economy.
From breaking news to sharp analysis, we deliver insights that help you navigate businesses, markets, and investment opportunities.
Nuvama presents CNBC TV 18 Market Central.
Providing sharp market intelligence for wealth creation with a commitment to doing it right.
This is Network 18, and you're watching CNBC TV 18.
की बिल वापस लेना होगा।
One of the long pending things, and I know we've spoken about this previously as well, is to deal with SEZs and whether this is going to be the budget that will move on that. Mr. Jory, do you think that's SEZ, special economic zone reforms, whether we're likely to see that coming through?
Yeah, so there are, on SEZs, there were two major issues that need to be sorted out. One is the duties to be charged when SEZs supply material into the domestic tariff area. And currently we treat it as if it were an import, a fresh import into the country. The demand from the industry has been that it should be like, the mover scheme where you just repay whatever taxes you'd foregone on the inputs, etc., when you brought material into the SEZ. I think there is merit in that, because over a period of time, what has happened is that, let me explain why, the government perhaps was reluctant to make this change. The perception in government at that time was that when SEZs were introduced, there were a whole lot of benefits on the direct tax side, which the developers and units in SEZs had availed of. And by bringing them at par with other schemes like Mover, they were getting an unfair advantage vis-a-vis other schemes. But if you scan the past couple of years, you find that those direct tax benefits have actually been eroded and they've been dispensed with over a period of time. So now you're caught in a situation where those benefits have lost their value, and yet you treat them differently vis-a-vis other schemes. So I think there is a good case for, extending the same kind of treatment to goods that are cleared from SEZs into the DTA. What that will also do is that it will broad-base your export promotion schemes. I think there's a plethora of schemes. And for example, there's this disparity between mover and SEZs, and that needs to go. The overarching imperative is that on SEZs, you've gone and created a huge sort of infrastructure, which is kind of lying unutilized, and that's a concern. So when you talk about industrial parks, and you talk about, the survey yesterday talked about how for manufacturing resilience, you need to focus on, these parks.
Yes, large clusters.
Yes, cluster approach. And SEZs are offering you that infrastructure. So,
Exactly.
Why would you not want to use it? So I think if there is the only impediment that's coming in the way is the tax treatment, then I think there's a good case for doing away with it. The other major demand from industry has been to allow SEZ units to do job work for units which are in the DTA. Because that gives them more sort of, that makes them more viable when the export season is not good. I think that is also something that needs to be considered, by the government. I don't know whether it will happen in the budget because it can be done by notification. So maybe it will happen during the year.
So outside of the 3-4 things that you touched upon that you believe we're likely to see come through in the budget, what do you believe the overarching direction is likely to be on the indirect tax side in the budget this year? In terms of intent, in terms of signaling, in terms of direction?
The intent quite clearly would be to use indirect taxes for supporting manufacturing. I think that's a very big imperative. If you want to do Viksit Bharat, if you want to shore up your share of manufacturing in GDP, then definitely you need to have an enabling tax environment for that. So I think when I talked about customs duty, the rate structure reform, I think that is what it will aim at. So I think the largest focus will be on that. And I also expect, more work on ease of doing business, and trade facilitation measures. For example, on the customs side, we are monitoring, the time release and the time it takes to clear cargo. And we still haven't got to the targets that were set by the National Trade Facilitation Committee, particularly on seaports. So I think there'll be some more work needed on that. I talked about how the Advanced Ruling Authority needs to be shored up. The National Assessment Centers need to be reactivated. So I think there are going to be ease of doing business reforms. We'll see some more measures there. I think the IT infrastructure for customs is also undergoing a revamp, and there is considerable scope for sort of improving, the taxpayer experience with that. So I think there'll be some announcements related to that.
On that front, Mr. Ranjan, let me ask you about the same question on the direct tax side. What do you believe the overarching theme and prioritization will be?
Well, I think it has to be consolidation and removing distortions, increasing the fairness of the system. Direct taxes are still viewed as being slightly unfair by a large section of the tax-paying population, and that's a very critical area which is normally not looked at. Because when you have faith in the system and you think it's fair, then there is more trust, and trust comes with better compliance, higher tax collections. And that's the way the things are moving. So I think we need to look at the law not just by rewriting it, but by looking at the distortions which there. One of them, as I mentioned, is the STT. Yeah. The other is the two different regimes or several options of how you want to tax yourself. I think there has to be clarity and simplification all the time, and a perceived fairness. And of course, there is, on the corporate side, I really hope that there is some strong incentive on the R&D front, which is again something.
Bring back the tax stops that had been phased out?
Yes. So in fact, a more intensive push on R&D. So now that we have the RDI fund, there can be ways of monitoring how taxpayers are using these incentives. So I think it should be brought back in a very big way, because we do need, it has been said by earlier panels, we do need development of skills and innovation, not just carpentry and electricians, but innovation, really, on all fronts.
Maybe we could see a return. What we did hear from the economic advisor yesterday was that conditionalities need to be attached to the incentives given, and the focus should be on R&D and innovation. So I don't know whether we'll see a return of or a new way of being able to address that issue. But let me ask the two of you this before we close. And Mr. Jory, let me start by asking you. In all of the conversations that we've had over the years, the overarching theme has been we need to expand the tax-to-GDP ratio. We need to do much better on that. And the attempts that the government has made in simplification, in rationalizing, and so on and so forth, with the intent of being able to do that. Why are we still stuck?
I wouldn't characterize it like that. I think on the GST side, there has been a fair amount of improvement in the size of the tax base. And that speaks to formalization of the economy, that speaks to better sort of ways of dealing with tax avoidance, tax evasion. So it's a little bit of both. It's organic as well as these initiatives the government have taken. So in terms of taxpayer numbers, GST has been a good story, except that you now need to focus on how many of them actually file returns that pay you tax.
Yeah.
So I'm still not sure of what is the percentage of taxpayers who are out there but who are actually filing nil returns. So that is something that we need to evaluate and assess. It's an ongoing thing, and we all talk about the culture of non-compliance to some extent complexities in tax laws. I think with the moderation of rates in GST, in GST 2.0, definitely I think compliance, it'll be a big boost for compliance as well in large swathes of the economy which have been affected by it. And as far as compliance is concerned, the government continues to work along with the states to improve compliance and get in better tax revenues. So I wouldn't characterize it as
stuck on GST.
Stuck,
okay, so what would you give it? A B, a B plus? How would you rate the performance of GST specifically?
Certainly a B.
A B. On the direct tax side.
Well, I think certainly a B plus, and a lot has been done. But I think the point about the tax-GDP ratio, that's an area which really needs to be looked at. The direct taxes are still about 6% of the GDP, which is quite low comparing it to the size of the economy, the growth in the economy.
And yet you're giving it a B plus.
Well, there are a number of reforms have been carried out. So the effort is certainly there, and the direction is right. I think it's just that somebody has to acknowledge that there is something more to be done on the tax GDP front.
Mr. Ranjan and Mr. Jory, we'll have you back on Sunday. Super Sunday is what we're calling it, the budget day, to see how much of what we've spoken about here is translated into action when the finance minister presents her budget. Thank you very much for your time. Ladies and gentlemen, a big round of applause for Akhilesh Ranjan and Vivek Jory.
Thank you
so much,
Thank
sir.
you.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship.
Young Turks at 22. Only on CNBC TV 18 and CNBCTV18.com.
CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV 18 weeknights at 7 p.m. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV 18 and CNBCTV18.com.
At this juncture, my thinking is that the government might want to bring it down by at least 10-15 basis points even this financial year. I'm basically saying that please don't cut it. Keep it. Certain tweaks, especially around LTCG, is probably warranted. It's not a very large quantum, especially the equity side of things. Probably government could have bans a couple of years down the line. So if you have more than 3-year hold or 4-year hold, maybe have the differential, taxes. I'm not expecting too much on consumption side of things. We've done a lot of things last year, and remember that GST impact of low collections will also be felt in this upcoming financial year as well.
UGC बिल वापस लेना होगा।
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. Procurement and cost reduction platform OneBuy.ai has raised 32.5 crore rupees in a seed funding round led by 100 unicorns. The fresh funds will be deployed to accelerate the development of compliant, scalable SaaS platforms and expand global data pipes.
Bengaluru-based health tech startup Biopeak has secured $2.7 million in a follow-on funding round led by NK Squared, the investment vehicle of Zerodha co-founder Nikhil Kamath. The startup plans to use the fresh capital to open a new clinic, advancing proprietary AI tools and developing clinical programs.
Fintech unicorn Cred reported an operating revenue of 2,735 crore rupees in FY25, a 16% year-on-year increase. At the same time, its operating losses declined 51% to 298 crore rupees in FY25.
Apple reports record quarterly revenue of $144 billion thanks to blowout iPhone 17 sales. Company says India revenue hits a record high with double-digit growth.
SpaceX is in discussions to merge with xAI ahead of a public offering planned for this year. Reuters reported the combination would bring Musk's rockets, Starlink satellites, X social media platform, and Grok chatbot under one roof. Well, those are the headlines we've been tracking for you this evening. The union budget is less than 2 days away, and for India's startup ecosystem, expectations are running high. After a year of tighter capital, cautious global investors, and sharper regulatory scrutiny, founders and investors are looking to the finance minister for clear signals on domestic risk capital, angel investing, AI innovation, and tax certainty. So what does the startup ecosystem really want from Budget 2026? Joining me now for this pre-budget discussion are Bruce Keith, the co-founder and CEO of AI-powered investment platform Investor AI, and Addison Appu, managing partner at early-stage investment firm Think08. Also with me, my colleague Arundhati. Gentlemen, welcome to Startup Street. Addison, let me start with you. As we move ahead into this budget, what is the one headline that you most want to see for India's startup ecosystem this year?
Thanks. So for us, the most important piece would be the government looking at rationalizing the LTCG and STT for income status recognition. And also as a part of AIF, if the current AI accreditation piece can be looked at, especially which has impacted the angel investment in the country. Those are the two most important factors that we would definitely want the government to look at.
All right, Bruce, if I could come to you now, from a founder's perspective, right, what is the single biggest gap policymakers need to address for India's startup ecosystem right now?
You know, I think we're moving in the right direction. You just have to look at yesterday's, CPI and GDP results. I think I would love to see more foundational and sector-specific AI models like the ones that we've built. And to make this happen, that means we need to strengthen and continue to strengthen the linkages with academia and the centers of excellence. And in the absence of that, we've got the best startup ecosystem in the form of DPI. So I'd like to see DPI play an even bigger role in foundational AI layer to allow more startups to build their apps on top of that.
All right, Bruce, so you want the DPI to play a bigger role. Let me go back to Addison. Addison, one of the loudest asks this year is unlocking domestic risk capital. You flagged that current SEBI co-investment rules are discouraging family offices. What exactly is broken in the framework, and how urgent is this fix?
We had a discussion recently with the government at Niti Aayog. So some points that came up for discussion was the mandatory accreditations investor status. There is mostly the co-investment formula which requires lower fee structure, direct exposure, and longer holding cycles for the family offices. And because they want strategic control, they can hold the investment for much larger piece of time. When we are investing along with the fund, they have to kind of exit between the 5-7 year threshold or 8 year threshold, whatever is the fund life. That kind of does not give them the right expertise to hold on to an investment for a longer period. And they end up going through the PMS route, which has got better chances of going through a longer cycle. And the 3x investment cap is also relative to the AI stakes. So we would definitely want the government to relook at some of these co-investment rules, especially from SEBI's perspective, that the mandatory accreditation status and the 3x investment cap and the exit status. Those are the three main points, because for a family office, they look for a much longer gestation period and strategic control.
Sure. So you want the government to re-look at these co-investment roles and exit as well. But Bruce, when domestic capital doesn't flow easily, founders often sort of chase offshore money or slow down growth, right? Do founders today still feel the need for overseas investors or offshore structures to sort of scale, or is domestic capital finally stepping up?
I've worked in 3 continents, and I've raised money in 3 continents, and I think the Indian equity funding ecosystem is really strong. So I accept all the points around kind of family offices and angel money, but in terms of the general equity funding ecosystem, it's strong. I think what I would like to see strengthen and grow is the debt funding side of the ecosystem. And as the market matures, I think we need to see both of these working in parallel. And I think that will come just naturally as the market matures. But right now, I don't see any need to go overseas for equity funding.
All right. Addison, picking up from what we are just discussing, India has no shortage of wealthy individuals, yet angel participation remains limited. Rules like mandatory upfront net worth certification and tight investment caps making angel investing unnecessarily exclusionary. And with high compliance and licensing costs for, Cat 1 AIFs and angel funds, is regulation today skewed more towards control than capital formation?
You have hit the nail on the head. See, what happened was, if you look at the last quarter data, angel funding has kind of dipped a long way because most of the angel funds are now getting restricted by the current SEBI notification that came out in September 2025. While SEBI is trying to protect some of the investors from tier 2 and tier 3, but the current stringent rules, if you look at the data, I think from about 3 lakh odd individuals who have high income filings, only 649 or 700 got accreditation certificates. And for a fund size of 200 or 300 crores, the compliance cost has just shot up because every individual investor is now going to go through the mandatory filing of getting accredited. So while it kind of is a check rule, it is kind of killing the ecosystem because as an angel investor, these angels are mostly practitioners, operators who have run their own companies, and they would like to come in from, say, TRL 0 to TRL 4 stage, which most of the funds do not want to touch, which is called the valley of death. So some of these rules of the 2 crore net worth certification, the 7.5 crore net worth, it is shrinking the pool, and that is kind of going to impact early stage funding. Although the government has given other leeways, but yeah.
So we're going to see some impact on early stage funding. But, Bruce, if you could quickly tell us from the founder's side, right? Do compliance and reporting requirements start biting even before companies hit scale, especially in regulated sectors like fintech?
Yeah, look, it's, as a fintech player, I think reg should bite. You really should be. We design. Reg in as a feature, not a bug from the outset. We design and build with reg in mind. And I think if you're a fintech or a wealth tech player and you're not doing that, then you're not really doing what's best for the end investor.
Okay, understood. Addison, another long-standing pain point is taxation, especially ambiguity around, VC carry and the overlap between GST and income tax. How much uncertainty does this create for fund structuring and long-term planning? And is this something the budget can realistically clean up? If you could quickly tell us that. See,
quick point. Capital gains is at 12.5%. If you do a performance fee, you are charged 18% GST, and then it can go into your income tax slab, which may be 30%, 40%. So as a fund manager, it becomes quite difficult to get parity. At the end of the day, it is an asset class, and it should be brought as an asset class of capital gain taxation purposes. And also, there is no safe harbor for the holding periods on the waterfall. So it becomes really tricky. We have just seen one of the high-profile cases rulings that came out. So if there is some absolute clarity about how to treat the income as a capital gain or as a performance fee, it will help a long way to push more capital in the country.
Sure. And Bruce, for operating companies, tax certainty matters just as much, right? At your stage with 50 crore rupees in ARR, how important are simpler, predictable tax rules compared to incentives of funding support? And from an investor's lens, are India's current policies doing enough to channel capital into AI and deep tech?
So look, firstly, I think this is a budget that's going to be long on sentiment. I think it's going to be about creating the right environment for entrepreneurs. We can't control the global stage, but yesterday's CPI GDP numbers are strong. We're moving in the right direction. So, the market rewards fiscal discipline and predictability, and I think we're going to see that in the budget. I don't think it's going to be one that's got lots of headlines, because founders and funding need that consistency as well. So I don't see that changing very much. And for me, it really is kind of more of the same.
Okay. Well, on that note, we'll have to wrap up our conversation. Gentlemen, many thanks for joining us on Startup Street today. Thank you so much for your time.
Thank you.
On that note, it is time for us to head into a short break. But coming up next, Unbox Robotics raises $28 million in a Series B funding round led by ICICI Ventures and Red Start Labs. We put the company's founder and CEO, Pramod Ghadge, on the hot seat to decode all of the key details. Stay tuned.
हमारी मांगे पूरी करो, पूरी करो, पूरी करो। यूजीसी बिल वापस लेना होगा, लेना होगा।
Welcome back. You're still with us on Startup Street. As India heads into a crucial union budget, deep tech and manufacturing startups are watching closely for signals on incentives, R&D support and supply chain infrastructure. One company right at the intersection of automation, logistics and manufacturing is Unbox Robotics, which has just raised $28 million in Series B funding. With warehouse automation gaining momentum in India and globally, the big question now is how budget policy can accelerate adoption and help Indian robotics companies scale. Joining me now is Pramod Ghadge, the founder and CEO of Unbox Robotics, and also with me, my colleague Shruti. Pramod, thank you so much for taking time out and being here with us on Startup Street. You know, before we get to what the expectations are from the budget, let me first ask you, you've raised this $28 million in a Series B round, and you're already profitable with 5x year-on-year growth, right? So what's sort of driving this demand for you, and how do you plan to use the funds that you've raised?
Yeah, thanks. So we started this in 2019 with the vision to build multi-robot systems where multiple robots can work together in warehouses in a very modular manner to improve the efficiencies of warehouse operations. So for companies like retail, logistics, and e-commerce sectors. The idea was to build a very differentiated systems from India for the globe. So we have been successfully deploying these robots from the last couple of years in terms of commercial deployments, and we have been now live across warehouses, more than 15 warehouses or 15 sites where we have deployed the systems across India, US, and Europe. And the current funding round is going to accelerate our deployments in the Western markets, specifically around Europe, US, and we'd also want to focus on launching new products along with the current product which we have, where we have been getting a very good customer traction.
All right, those are the plans, those are the fund deployment plans. Pramod, this is Shruti quickly stepping in. Your platform combines swarm intelligence software with modular robotic sortation hardware. What's the hardest part of the system to replicate? And tell us how it translates into measurable gains for your customers.
Yeah, so in the last 5 to 6 years, we ended up coming with a very new concept, unlike the traditional way of sorting packages in warehouses. We came up with a very high-speed mobile robotic system that has a very differentiated swarm intelligence software which manages the whole fleet of robots. So it can be 10, 50, or 100 plus robots, unlike the traditional way of managing the operations. And the second thing which we have been really differentiating on is very differentiated hardware and firmware systems. So these are very high-speed 3D robots, which we are able to run at a very high speed and get a good acceleration values. This allows us to run the operation with a lesser number of robots compared to, let's say, maybe a competitor will do this. So the idea was always to have a very let's say, modular, flexible robotic system that can be deployed in a very flexible manner, very quick, maybe 1 or 2 weeks of installation times, and then easy to scale as well, which reduces the friction to deploy automation.
Sure, absolutely. And you know, the budget is on Sunday, right? It's less than 2 days away. India's manufacturing push and PLI schemes are sort of critical for hardware startups, right? What specific budgetary incentives, whether production-linked support, tax breaks, or capex subsidy, would most accelerate robotics hardware adoption in India?
Yeah, so we have been looking at this, and I think India's current logistics costs are still, let's say, on a higher side compared to, let's say, the GDP numbers. So if you want to run a very efficient logistics or supply chains, we need to have prioritization and how do we automate or digitize our supply chains and warehouse operations. And for that to happen, it will be great if we can get support in terms of any capex incentives to adopt more and more automation, more digitization across warehouses, so that we can run these operations very efficiently in terms of productivity or costs. And also in terms of, let's say, if we can prioritize the R&D generation or R&D or IP generation from India for the world, and getting the incentives to boost that, again, we will be able to get many robotics companies coming out of India and building for the globe, and it will help in the long term for us. And the third thing is the talent. If you want to retain the talent and not lose the talent to other countries, I think we'll have to relax the taxation on the ESOPs or maybe get some incentives on those parts as well.
Sure. You know, picking up, Pramod, for what you just mentioned, warehouse automation and intralogistics are deeply tied to national logistics competitiveness. So what policies or budget allocation should the government prioritize to reduce structural costs in the supply chain, and how would that unlock faster growth for robotics players?
Yeah, so we have seen in some other cases in other parts of the world, like where we work with several European customers as well, where the governments are incentivizing them to, let's say, giving incentives to automate their warehouses. It can be an incentive to automate, or it can be an incentive to reduce the energy consumption versus the traditional ways to do this. So any capex incentives or participation from government will be, again, helpful for the companies to adopt more and more automation. And the other thing will be on incentives to build the full products like robots or, let's say, mechatronic systems, just like PLI schemes, again, will help the startups to build in India, manufacture in India, and then export these products to outside India, like, let's say, the Western market or the other markets, wherever they can basically find them, the usage.
Sure. And if you could quickly tell us in 30 seconds, tax credits for automation startups or expanded ESOP support would meaningfully change the fundraising and hiring landscape for these startups.
Yeah, so deep tech or the fields where we operate in, I think it's it's highly important that we have this talent retained in India and not lose this talent. So in order to attract the good talent within the deep tech companies, it is definitely will be better if there are incentives to relax the ESOP taxation norms to retain the talent and give these ESOP units or the incentives to the employees to stay longer. And deep tech is generally longer, so you need to stay long in terms of the R&D cycles are longer, so you need the talent to stay with you. And then, of course, you can reap the benefits later. Yeah.
All right. Thank you for sharing your wish list with us, Pramod, today. Thank you so much for your time and wish you the very best.
Thanks a lot, both of you. Yeah.
Well, moving on, Budget 2026 is around the corner. Defense spending is back in focus, and former Defense Secretary Giridhar Armane tells CNBC TV18 capex could rise 15 to 20% or more. A new Traction report shows India's defense tech startups are gearing up to ride that surge. Aishwarya Anand brings us the key takeaways.
India's defense technology sector is entering a critical inflection point, and it comes just as the government weighs a fresh push to attract global capital into defense manufacturing. According to a new Traction report, India now has more than 200 defense tech startups, but only a small elite group is scaling into serious defense suppliers. While innovation is widespread, less than 10% have been able to raise Series A or beyond, underlining how capital and procurement are concentrating around a few execution-ready firms. The sector has attracted over $711 million in funding so far, with more than half of that flowing into just 5 companies led by drone and aerospace players such as Rafi, IdeaForge and New Space Research. Now, what's changing is the scale of capital. Funding jumped to $247 million in 2025, the highest ever for Indian defense tech, driven by large late-stage rounds as investors shift from experiments to defense-grade manufacturing. This surge is coming as the center is weighing raising the FDI cap in defense from 49% to 74%, a move that could bring in global aerospace and defense majors just ahead of the union budget. Back to you.
All right, Aishwarya, thank you so much for taking us through those details. But moving on, it is Friday and it's time to take stock of all the deals from the startup world this week. According to Venture Intelligence, this week saw 20 deals worth $99 million. Some of the notable deals include Easy Home Finance, which raised $30 million from Investcore Group, Claypon Capital and SMBC Asia Rising Fund. Oncology player Forbase Care got $9.81 million from Ashish Kacholia, Yali Capital and others.
Well, Arundhati, that's not all. Enterprise tech startup SpotDraft got $8 million from Qualcomm Ventures, while AI compute solutions provider Grani Labs raised $8 million from Peak 15 Partners. Finally, pain management clinics chain Nivan Care added $7 million to its kitty from Sorin Investments, Rebright Partners, India Partners and W Health Venture. This year has seen a total of 86 deals worth $631 million as per Venture Intelligence.
And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching. More news and updates coming up next.
पूरी करो यूजीसी बिल वापस लेना होगा
very much for joining us here on our pre-budget conversation, our pre-budget dialogue, as we examine the choices that the Government of India is faced with ahead of the Union budget. As is very clear, and as you just heard there from Shivani, we are dealing with a volatile and a complex geopolitical environment. There's been plenty of geo-economic fragmentation as well, and the confrontation continues on that front. In that backdrop, it is going to have to be a balancing act that the government puts together, but every budget is a balancing act, and to really help us understand the choices that the government may make and the priorities that it must focus on is someone who has plenty of experience in budget making. He spent a large part of his time in North Block putting together many budgets, and of course retired as the former Finance Secretary. Mr. Garg, always a pleasure. Thanks so much for joining us here. Before we talk about the priorities, we're 48 hours away from the budget. Is it all final by now, or is there any scope or any leeway for any changes? In your experience, in the last 48 hours, have any big changes been made to the budget when you were around?
See, no changes made in the tax proposals or expenditure proposals. It's the speech on which last 48 hours are spent. That is still going on. That gets finalized only about 4 to 5 p.m. on the budget day, day before budget. Okay. That is tomorrow. So that is the only work which goes on at this time. Of course, the printing work and is what takes place at this time.
Okay, so the printing work obviously is already done, but if the finance minister wants to, sort of signal something to the market, signal something to investors, there is still scope for her to do that by way of the budget speech.
Of course, you can always include any proposal you want, big or small, in the last minute in your speech. It may not find mention in the budget documents as such, but you can make the proposals allocation or during the course of the year. So that is possible.
The scope for announcements is still possible. So let's get started, Mr. Garg. As I pointed out, we're dealing with a fairly complex environment globally. Domestically, growth projected between 6.8 to 7.2%. That is what the economic survey is going with. Nominally expected to be between 10 to 10.5%. That is what the CNBC TV 18 poll is suggesting. In this backdrop, what do you think the government's choices will be? Should we expect, should the market expect, should investors expect an even higher allocation on capex? What would you be penciling in?
See, the world is going through a massive transition. I would not call it complexity as such. It is a very big transformation going around. Chinese economy has grown. Europeans are also coming back. Americans are behaving in a very different world. So these three blocks now going up. And the old world order, the UN and other trade agreements, etc., are going down. It's a new world which is emerging. So you are faced with a situation that in this new emerging world, how do you deal with it? How do you shape up your policies and programs? And in that context, capital expenditure or the spending for economic growth kind of thing is one of the very important function of the finance minister. If you do the hard budget sort of crunching, number crunching, of the about 51 lakh crores of the budget for the current year, roughly about 11 crores is spent on the economic growth, including
11 lakh crores.
11 lakh crores. Yes. That is not capital expenditure alone. There is a lot of revenue expenditure, which also PLI, by the way, is a revenue expenditure. So taking PLI, the revenue expenditures as well as capital expenditure infrastructure, that adds to about 11 lakh crores. That expenditure would be one where the finance minister would be looking very closely, that what do you do for the next year? There is one major constraint in my judgment, since revenues are not growing well. So the finance minister would be hard pressed to sort of decide how much to increase the overall size of the budget. In my judgment, that may not be possible for her to raise it beyond 5 to 6%.
Okay.
So if you raise the total budget expenditure by 5 to 6%, and you have certain expenditures to take care in any case, like the interest, which grows at much more higher rate, And the Finance Commission recommendations would also be coming, which will require greater allocations for the state transfers, etc. In that situation, can you increase the capital expenditure as well as the other economic growth expenditure by a very large margin? I suspect that space is not there. So I would see that this, in my judgment, it will either be more or less at this level, or maybe a couple of percentage higher than that.
Okay, so single-digit increase is what you're anticipating as far
Lower single-digit.
Lower single-digit increase is what you're anticipating as far as capex allocations are concerned. But Mr. Garg, let's talk about whether the government should or has the space at this point in time to do anything as far as, for instance, the long-term capital gains tax is concerned. I'll ask you this in the context of the fact that you were in North Block in 2018 when your colleague in the Revenue Department, Hasmukh Adhia, brought in the long-term capital gains tax. A, do you believe that a reversal, a rollback is warranted given the fact that India wants to attract flows? And B, do you believe the government will take that step?
So you see, last year, the government did take two big tax adventurous steps, if I may call it. The income tax limit was raised to 12 lakhs for everyone, which in fact took away lots of taxpayers from actually paying taxes. The numbers don't come, but in my judgment, there are not more than 2 crore actually tax-paying people now. Then you saw the GST cut being announced, very major for pleasing the middle class, which is essentially also earns by way of the capital gains, etc. So if you look at from the point of view of that this is a constituency which the government thinks politically is required to be sort of assuaged or pleased, so to say, the government may embark on this kind of adventure again. But if you look at actual results of it, these two cuts did not lead to much of the consumption expenditure or consumption expansion in the economy. And you also look at the fact that the taxation of wages or salaries is much higher at 30% plus, and the capital gains in a way are taxed at 12.5%. So an easier money in a way is taxed at lower rate, or the harder earned money is taxed at a higher rate of it. There is no space, or even in principle or otherwise, and the government's tax revenue growth being very small this year. So on merit, there doesn't appear to be a case or a possibility, but if you are targeting politically or otherwise, you may have. But even from that point of view, in my judgment, the cycle of elections this year are not the ones where the government would like to sort of take a risk of reducing the tax, because the possibility of winning those elections on the strength of these kind of tax cut is much less than what it was last year before Delhi election this was brought in. So my sense is no likelihood
likelihood of a rollback as far as the LTCG is concerned, or even a cut at this point in time. Let's then talk about what the economic survey has laid out, and in the context of that, I would like to understand what you believe the budget may choose to prioritize. I think the underlying message of the survey was that the Indian state needs to become much more entrepreneurial, and the Indian corporate needs to become much more competitive. In that backdrop then, export competitiveness, measures for enhancing exports, any new schemes that you believe that the government may bring in to drive and further accelerate exports?
See, the state's principal job is to deliver good public goods and services well. The state is not a business entity. It doesn't need to be entrepreneurial in the sense of business person, right? So that advice...
It needs to be entrepreneurial in the sense that it nurtures and allows businesses to be much more entrepreneurial.
So it should be policy entrepreneurial. It should come up with, the government must come up with the right kind of policies, right kind of economic structure, right kind of macroeconomic management, currency management. And that is where the government can be entrepreneurial in the business sense. Not, and But if you look at, so we run very large number of public sectors. Some of them are efficient, but many of them are not efficient. That is where the government acts as a businessman. So you don't need to be entrepreneurial in that sense. You divest better. That would be entrepreneurial. There is an advice in the economic survey to consider this.
Yes.
For last 5 years, if you look at, virtually the disinvestment, the privatization of business has been shut.
Yeah.
So that is lack of entrepreneurship in the policy sense also in my mind. So if the government can become entrepreneurial, one thing it can do is to sort of scale up the disinvestment and the privatization program. The second one, which I think has been displayed in the deal which we have done with EU, is that expose the businesses and industry to the competition, the international competition. The way the government has rightly reduced the duties on automobiles and many other things in the EU and earlier in the UK FTA, I think that's a right way to expose the industry to the competition and to show the government's entrepreneurial face. It's not good to have more and more of PLIs and those kind of things, or provide incentives or interest subsidies, etc. That's not entrepreneurial. That's actually making the industry and the businesses overprotected and weak. So if the government can actually become entrepreneurial in this sense, I think it will do a great service to the nation.
And I think there was a hint there, and there was a signal from the economic advisor saying that protection must not be in perpetuity, also suggesting that incentives should be linked to higher productivity and should be conditional on what companies can achieve in terms of exports and so on and so forth. Do you believe that that perhaps is going to be the way that shapes policy?
For the government, it's very difficult to do this fine-tuned kind of analysis that when are you getting, your time is enough, protection is over, good enough, now move. It's very difficult. There used to be one very economic argument for the government, that was the infant industry argument. That there is always a stage whenever there is an evolution internationally and globally, certain new industries come up. They need to be given some handholding in the form of R&D support, in the form of infrastructure support, in the form of some procurement orders and things like that. So that is there today. There are many industries, for example, let us say energy transition, solar, or the digital transition, or the electric vehicles and many other kind of things. So these are the industries which in the classical sense of an infant industry argument requires government support. But for the mature old economy industry like steel, aluminium, or MSMEs or whatever, they don't require any support. The time has been long gone for those subsidies and supports to be withdrawn. Do it fast, immediately, rather than perpetuating them any longer.
So the sun must set on some of these existing subsidies. That's the message that you're sending out, and offer protection to infant industries or sunrise sectors. And we've seen that happen even as far as the India-EU FTA is concerned, where EVs have been left out of the tariff reduction plan, at least for the next 5 years.
Good evening. Let's do it right with Nuvama presents The Wealth Brief, where today's market moves are decoded to guide your wealth journey. Market snaps 3-day winning streak as all major indices close in the red. Nifty falls below 25,350, with Hindalco, Tata Steel, Coal India, ONGC, and ICICI Bank among the top losers. Sensex drops 297 points to 82,270. Nifty down 98 points to 25,321. Nifty Bank falls 347 points to 59,610. and the mid-cap index slips 109 points to 58,432. Market breadth remains positive despite the decline, with advances outnumbering declines. Metal stocks underperform as the metal index slips and Hind Copper, Hind Zinc and others fall up to 12%. In individual stocks, Swiggy falls over 5% as its net loss widens to 1,065 crore rupees and CLSA downgrades the stock. South Indian Bank drops over 15% as its CEO does not seek reappointment. Ambuja Cements and MOIL declined 5% and 4% post-earnings. On the upside, Nestle gains 3% as the top Nifty gainer after strong Q3 results. Indoco Remedies rises 2% following US FDA approval for lacosamide oral solution, while Vodafone Idea jumps over 11%, emerging as the top mid-cap gainer. Investments in securities market are subject to market risks. Read all the related documents carefully before.
माही, कोई cool bank suggest करो ना, जो socially conscious हो.
फिर तो SBI coolest है.
Really?
SBI ने होनहार बच्चों को scholarships दी, गांव के youth को train किया, specially abled को support किया, villages को adopt किया.
That's so cool, man.
SBI, the banker to.
CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV 18 weeknights at 7 p.m. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day.
Defense, and I think there is unequivocal consensus on it. This is the first budget post-Operation Sindoor. We're likely to see a higher allocation. In fact, we've got our budget editor, the former Defense Secretary here with us, Girdhar Armane, and he'll of course also join us to talk about that. But defense spending, you believe that we're likely to see a significantly higher number there?
So there are two broad defense expenditure heads. One is the revenue head where you take for salaries and pensions and things like that. And the other one is the capital outlays where you provide the capital outlays for sort of raising the capacity and the war readiness of the defense sector. So I think you were talking about this capex kind of thing. So which serves two purposes. Number one, it serves the purpose of keeping the country's readiness for taking on any war, and if there is a bad environment kind of thing, you need more of it. And second, it also has an economic dimension that if you produce many of those things domestically, it gives a boost to the domestic industry as well.
Yeah.
So considering...
And also links back to the pivot that the chief economic advisor is speaking of, strategic indispensability. Perhaps this pivot could be linked to that as well.
Quite right. If you use both the words, strategic
and indispensability,
so then it becomes very much relatable to defense.
Yeah.
Right. So it looks very, I think, very easy to say that there has to be and there would be an increase in the defense outlay. You can say it, but there is a constraint, the overall constraint. So how much the government will have the legal space to allocate higher amounts for the defense, whether it's 10% higher or 15% higher. But I don't see any possibility of it being beyond 10 to 15%.
10 to 15%. That brings me then to the question, Mr. Garg, because what I hear from you is you believe that the government has limited fiscal room to maneuver, given the fact that it stated its objective of maintaining this fiscal glide path. In that scenario, do you then anticipate expenditure compression?
See, there are, the government's expenditure, unfortunately, is so tightly done that you have very little space to reduce, except in the situation where you take a very large strategic view. And let me illustrate. For example, capital expenditure. We spent about 5 lakh crores over 3 big items: railways, roads, and the metros, right? If you do a very careful study of the effectiveness, productivity, and its contribution to economic growth, you would find that there is very little economic growth impact of these kind of expenditures, right? Look at railways. Get hard facts right. The National Economic Statistics bring this out. What is the contribution to GVA of this expenditure? What is the kind of increase in passenger traffic which has been brought about in the last 5 6 years? You would find that these expenditures are perhaps not that effective at all. Now you have alternate. I talked about energy transition. You have the digital transitions, data centers, many other things. Energy transition requires enormous amount of expenditure.
As do data centers.
So if we look at that strategically, that this 20th century industrial economy kind of expenditures on railways and roads and metros or BSNLs, which is a sinking well. So instead of those expenditures, you reduce them, and part of that, even half of that, if you transition towards the new strategic sectors, then you may have space to do the right kind of thing. But if you don't want to touch them, there is no space for doing anything better and good.
You know, and that brings me then to the question about the Finance Commission, because what people don't realize is that we've also got the Finance Commission's report, which will be tabled along with the budget. So there's 2 big documents to go over on Sunday, which is the 1st of February. The impact of the Finance Commission, Mr. Garg, do you believe that the Finance Commission is likely to change that 41% devolution number, which is what the center guarantees to states?
See, the Finance Commission has to balance what is the state's needs as well as what is the center's regal space, that how much central taxes can go. I think over the year, this formula of 42%, including J&K, and 41% excluding J&K, I think this has come to a level where there is a fair balance. And it has got a political acceptability in the country as well. States keep on demanding 50%. But 42%, I think, is a level which is acceptable to most of the states easily. If the Finance Commission has recommended a reduction in that, that would be political hierarchy to my mind. So I don't think Finance Commission would have recommended it. But even if the Finance Commission has recommended it, I don't think government will accept it. So that I take it as given. There is one big head which the Finance Commissions have been sort of recommending large amounts of money. We have this called the revenue gap grants kind of thing. Because Finance Commission, when it does the calculations that the state's required or legitimate expenditure is this much, and post-devolution, if the availability of resources is this much, and there is a gap, that gap is sought to be filled up by these revenue grants. Last time, if I remember, I think it's 2.5 lakh crores or something was recommended. This is pernicious. I don't believe that these grants are right.
Okay.
Because these grants make what we were talking about, the weaker industry, it makes the weaker states over-dependent upon the center. So if you can do away with those grants, though again it's very difficult for the government to do it, but if those grants can be done away with, then perhaps there might be some sort of saving. By the way, by the time you come to the last year of the previous Finance Commission recommendation, these grants are very small.
Right.
Right. So I don't think there would be a big effect on the whole, even if the Finance Commission has recommended no revenue gap grants. So I don't think the government can look at any sort of fiscal space because of the Finance Commission recommendations. All it can hope is that it does not put additional burden. on the government.
So you anticipate a status quo, even if the Finance Commission doesn't recommend it, you believe the government will go in for the same number as far as the devolution is concerned. Let me ask you two quick questions before I let you go, sir, because it's not just the Finance Commission. For those of you who may not know, we are moving to a new series. The base year revision is also happening, which will of course impact the way that we calculate CPI and so on and so forth. And here's what Mosby is saying, Mr. Garg, so let me put that to you. The new CPI series to have a lower weight for food to have a weight of 34.77% in the new CPI series, beverages to have a weight of 1.77%, and the combined weight of food and beverages now at 36.54% versus almost 46% in the previous series. Will this reduce the food volatility, the food inflation shock, the food inflation volatility that we've otherwise seen?
Of course, I think this is an overweight, which our CPI has it. So our indices for measuring the inflation need to be reformed. This is one necessary reform. The other one is this producers price index, which we have the wholesale price index, which does not even have the services there. So we have a very awkward system of the wholesale or the producers price indices, which does not even measure the inflation in more than 50% of the economy. So the whole thing needs to be improved. How much it will have the volatility effect is difficult to judge, because food, of course, is very volatile, which you have seen in the last year. But I think the other index which need to move is to move this the base year for the GDP from 2011-12 to somewhere 22-23. That's more necessary, because one of the necessary implications of that is that what we have the difference between the real and the nominal GDP will go away. Because as you come closer in the base, the difference goes away. And that is where, to my mind, one of the very key, we flaunt it, that we are the largest growing economy in the world with 7% odd growth for the current year. But if you look at the nominal, which in the international sense is better measured in the dollar GDP growth. So we have nominal growth of 8% for the current year, and we have 6.5% depreciation of rupee against the dollar. So our dollar growth internationally is only 1.5%. So which is one of the lowest in the world. So for the rest of the world, what matters is not what your real GDP growth is, but what is the dollar GDP growth of the country in the comparative sense. That is one of the lowest.
That's a whole other debate and discussion, Mr. Garg. But if you were in North Block today, with the rupee being at 92, how much do you think that is going to weigh on the finance minister's mind as she puts out budget 2026?
See, there is one positive spin-off of the rupee depreciation, because
for exporters.
No, for the government revenue. So what happens is that the RBI surplus is essentially dependent upon how much rupee depreciates against dollar and what is the international dollar interest rates. And since both of them are favoring in a way, you can expect higher dividend of 50,000 to 75,000 crores more next year. So that, for the finance minister, in a way, is a beneficial thing to happen. But oil, for example, is where you affect adversely your subsidies on petroleums and gas and fertilizers. That, fortunately for us, in a way, the international oil prices have been subdued. So that's not a problem. So on rupee depreciation, I think finance minister can feel a little relaxed.
A little relaxed, even though the headlines are focusing on the sharp and swift decline that we have seen, but expect a significantly higher dividend from the RBI. So perhaps another RBI bazooka by way of a dividend is what we should expect on account of the rupee depreciation. Mr. Garg, thank you so much for kicking things off here on the Budget Vision 2026 as we look forward to the next 48 hours and wait for Finance Minister Nirmala Sitharaman to present her record-breaking 9th budget. Ladies and gentlemen, a big round of applause for the former Finance Secretary, Subhash Chandra Garg. Thank you.
Respect for international.
This is Network 18, and you're watching CNBC TV 18.
At this juncture, my thinking is that the government might want to bring it down by at least 10-15 basis points even this financial year. I'm basically saying that please don't cut it. Keep it at 4.4. If you were to just broadly look at the last 2 years, we've been doing sub 10% rate from a capex standpoint because in 2024 we actually didn't grow at all. So anything above 10 in my view is still respectable. Certain tweaks, especially around LTCG, is probably warranted. It's not a very large quantum, especially the equity side of things. Probably government could have banned a couple of years down the line. So if you have more than 3-year hold or 4-year hold, maybe have the differential, taxes. I'm not expecting too much on consumption side of things. We've done a lot of things last year, and remember that GST impact of low collections will also be felt in this upcoming financial year as well.
UGC बिल वापस लेना होगा।
Who realize the consequences of not agreeing with the president. The consequences are such that, David, I don't think you want to risk it.
You want to risk what? Sorry.
Being on the other side of the president.
You don't want to risk it.
Has anyone done well that has been on the other side? How about if Hassett went in there and said, we got to rethink this Iran thing? But how long would he be there?
So you think if it's a choice between the data and good policy for the country, it's better to stick with the president?
Yeah. This is not the same president as the one since Washington. This is a different guy.
The only things I would offer, guys, and again, we don't cover the Fed as closely as obviously some here. I've been able to spend a little time with Warsh. I mean, he does know the stock market really well. He's been working with Stanley Druckenmiller for a long time at Duquesne, and of course, he doesn't like QE. And that may be reflected in what we're seeing in terms of the futures and the
you must share the attitude that I'm saying is not a heretical attitude. Right?
Say again?
It's not a heretical attitude.
No, but he has been hawkish in the past, certainly was viewed as hawkish when he was a part of the Fed. That's quite some time ago at this point. But then I also think we clearly know that he's not a big fan of QE, and there is an expectation that would be rolled back more significantly. The balance sheet, Carl, is still where? It's like over 6 trillion? I don't know where, 6.8, something like that.
Meantime, there's still Senator Tillis in the way, who, by the way, this morning says he will continue to oppose any nomination until the DOJ flare-up with the current Fed chair is resolved. And Warren sort of backs him up today. It's a key voice in Senate banking.
Well, I get that. But again, I come back to the idea that it's not like that Trump has some sort of wild-eyed way. Trump just says that you can have great growth, low inflation. And I think that if you take this job, you agree with that. And that's okay. It's not, I think that many of us would say, well, listen, wherever the chips fall, we're going to do what's necessary. So if inflation heats up, and with growth, then maybe we have to tamp growth down. I just don't think that you're buying into that if you're Kevin Warsh. Maybe this Damascus-like conversion that he has when he gets with the president. That's what a lot of people
But when
have.
it comes to qualifications to be Fed chair, nobody can argue that he doesn't have them.
Oh,
right?
I'm not saying that. Again, I'm not saying. I'm just saying that if you take this job, you do not. You know what happens if you disagree. And
you become an enemy of the president.
Right, and that's not a great position to be in for anyone in this country. Anyone that we know, if they are the enemy of the president, says behind not on air, wow.
Yeah, I know, but he's going to have to deal with
here.
with a bunch of Fed governors who may disagree with him.
Okay, forget it. He's not going to be a housemate for the president. What do you want me to say? I'm saying.
I guess one example would be the current chair hasn't gone anywhere despite all the browbeating. In fact, he might stay on.
That's true. He could stay on, but Jay Powell is a man of different set of principles. I think there are a lot of people would view this as a cabinet-like appointment because that's how I think Trump believes in it.
It's not a cabinet. It's not a cabinet.
It's not, but I understand your point. He views the Fed the same way he views the DOJ or the FBI.
Right. Now,
I control them.
Right. Now, I mean, think about the DOJ has historically been sacrosanct, other than Bobby Kennedy, the brother of President Kennedy. I mean, even the DOJ was very sacrosanct against Nixon. I just think the DOJ is regarded as being the president. It's an arm. It's like his law firm. And I think, okay, I'm going to say it, even with Warsh in, I think the president regards it as his bank.
Okay, well, we'll see how it all goes then.
Oh, that's really great.
Yeah.
That's good. That's what I often say. Like, how about who do you think, Seattle or the Patriots, or do you see how it goes?
No, let's see how it goes. I think Seattle.
Right.
But
You're not. Well, the next question then is, do you expect it to result in destructive policy?
Well, no, because there are other people, and I don't believe it's destructive. See, this is where I think I don't believe that view of the president's is that far off. Because I think that you want to have a growing country because you want many more people to participate in the growth. When you listen to Steve Squeri this morning, like I talked to him in American Express, the rich people are doing great. I think the attitude that the president has, that I think Warsh should have, is that maybe others should participate too. I listened to Andrew's Mondami interview. I mean, look, we can't have two countries. If you promote great growth and accept a little bit of inflation, then more people would get wealthy. Now, I'm on the other side of Powell, too. I'm not against what the president wants. I'm just saying that if you take Warsh's attitude, it's probably in sync with what the president wants. And the president's not asking for some sort of crazy thing here. He wants more people to do better. He does. You can't. Have more people done better in the last few years in this country? No. It's been just this rich group. And I don't think that it's so crazy what the president wants, and therefore, if Warsh toes the line, I don't think it's that bad. I don't.
We'll talk more about what it means for Fed independence. Last night, the president sort of framed it as an us versus them thing between him and Fed governors. Steve Leisman's got some more breaking news on the Fed this morning on a busy day. Hey, Steve.
Yeah, Carl, this is worth paying attention to. I think Fed Governor Waller explaining his dissent, saying the policy rate should be closer to the neutral rate, which he considers to be 3%. Put another way, he thinks there's another 50 or 75 basis points the Fed should be lower right now. Monetary policy, he says, is still restricting economic activity, and he's very worried about the job market. Says the data is making clear that further easing is needed. The labor market it remains weak, and he goes on to say the 2025 jobs data will likely be revised to show no job growth. There's substantial deterioration in the labor market, he says, is a significant risk that he wants to watch out for. It's appropriate monetary policy to look through tariff effects. This, of course, coming with a higher than expected inflation, wholesale inflation, this number, as long as he says inflation expectations are anchored. Excluding tariff effects, Fed is on a path to the 2% inflation goal. And, Carl, I just want to agree with you. It's not a cabinet position.
Thanks for the clarification on the act.
I just think that, look, I don't think this president regards...
Not yet.
No, I don't think this president regards the same kind of separation of Fed and state that others have. And frankly, if anyone really disagrees with me, I mean, look at it. All the people
you're right.
points.
He doesn't view it in that.
But I also think that. But I agree with Waller. I agree with Warsh. I mean, I'm seeing if you look at automatic data, if you look at paychecks, if you listen to Judy Marks last night on Otis, if you talk to any of the housing executives, things are getting more stagnant. They are, and I don't think it's wrong to agree with what Warsh is saying or what Waller is saying. I mean, it's okay. I talked to all these executives; things aren't as good as they were. And if we take AI as what David was talking about in this dystopian world, things aren't getting better.
That's Dario Modet's view. Yeah.
It sounds.
Well,
like,
you don't have to worry about it actually, because we're all going to die.
Well, there's a good
Billy.
piece.
Are you Billy and the Predator?
There is a good piece in the FT today about the layoffs we've seen just this week from Depot, UPS, Amazon. 52,000. That's this week.
Look at the UPS.
But can we really point
Amazon.
to AI? I mean, are the companies making it clear? Some in the commentary includes mention of AI, others does not. It's not as clear to me. Meta what?
Meta is using AI.
I think arguably Jassy too.
Yeah,
Yes.
but Meta didn't talk about layoffs.
I think that when you read through the lines of Meta, he's saying that AI, the agenticses are writing the code for a lot of us. Well,
No, I know we use that. I focused on that in the coverage of Meta. I know that, but but they're not laying people off saying it's because of AI.
Well, what is it because
I mean,
of?
they're not laying people off.
What is it because of?
Post-pandemic overhiring.
Right, that was Amazon that announced very large layoffs.
Right, no, but I'm saying when you listen to the conference calls, you don't hear it. When Meta is a growing company, I don't think that they're going to be hiring as many people as they would.
I think that's absolutely true. My only point is we have yet to really see the complete linkage between companies' hiring plans and/or firing plans and the advance of AI within their
I
organizations.
agree, but Jensen Huang would tell you, look, it's going to happen. It's going to happen.
Of course it's going to happen. And it's going to be an issue that Kevin Warsh is going to have to deal
That's
with.
why I think, again, I don't think it's such a bad idea. It just happens to agree with the. Well, my view happens to coincide with the president. I'm sorry.
Can we get to Apple?
I'm sorry.
You want to get to Apple?
I'm sorry.
I know you were reading that conference call very closely last night when I joined you, so let's get to Apple.
We had dinner last night together.
Oh, I hope it was good.
At Phuket, it was very good. I had the Dover sole.
Yummy. Let's get to Apple. It is a record-breaking quarter, at least that's what the company says. Q1 beat. iPhone sales up more than 23, helped by stronger demand in China. Current quarter revenue guide comes in above consensus, but the company says that higher memory may impact gross margins. Jim, that was sort of an incremental discussion about maybe more this quarter than last quarter.
All right, now look, the long knives are out for Apple, which is ridiculous. The gross margins were gigantic. They were staggering, okay? I don't think that you can just say Apple's another NAND customer. I think it's entirely possible that they may have something better. NAND being one of the memory sources. Now, they're up huge. I mean, up, you could say anywhere between 200% and 500%. But when I look at who Tim Cook is, he is a supply chain genius.
Yes.
It's one of the reasons why he got picked, David.
Yes.
I think if there's anyone who can confound SanDisk, it will be this man.
Yeah.
No, he's just going to tell you, hey, listen, flame me.
I'm going to agree with you.
You are.
But by the way, that revenue number and the guide, and you get nothing in the stock price because it's all about worries about memory. Is that what I'm supposed to believe?
Just like they did with tariffs. Remember all these naysayers with tariffs and it didn't matter? Listen, if you go to T-Mobile, do you think that you're going to get a cheaper price on like a Samsung phone? I mean, the one that they subsidize is this.
Right.
And how about China? We should forget about China. China was like unbelievable.
The point you're making is as memory continues to be in very difficult supply, the price goes up, and therefore will that stem demand from iPhone buyers? Right. I guess that's what you...
The answer is no.
And you don't believe so?
No, because people buy it from Verizon. They buy it from T-Mobile.
Guys, I did choose a couple of different sound bites from both the Apple and the SanDisk call that I thought were appropriate.
How about my call? No?
Yeah, you got something?
No, I'm saying, didn't you listen to my call?
Yeah. Well, I have Tim Cook saying memory had a minimal impact on the first quarter, so the December quarter gross margin, we do expect it to be a bit more of an impact to the second quarter gross margin. And beyond the quarter, we don't obviously provide outlooks. We do continue to see market pricing for memory increasing significantly. as always, we'll look at a range of options. As you point out, they're the elephant. They can,
Yeah, I mean, look, now Sanders was very arrogant in the call, as far as I'm concerned. Although I love the guy who runs. He's
doing okay this morning.
He's deserved it. He's been under pressure for so long, David. He's a terrific guy. But I do think we have to know who we're dealing with. Apple, free cash flow for Apple is $51.5 billion in the quarter. For Meta, it's $14 billion. For Microsoft, it was only $5.8 billion.
Well,
I mean, they had a lot of room.
Look at their capex numbers. They're in a completely different world than Microsoft or Meta or Amazon, completely or Alphabet.
Well, they're all
their capex numbers are nothing compared to them.
Well, how about the fact that I asked him about how much this Google relationship's going to cost. Now, all these people are saying that Google's going to cost them a fortune, right? And it wasn't like he really addressed it. He didn't address it. So how are they able to come up with that? First, as I say to Tim, this is our pre-interview. What are the actual terms? People say it's $1 billion back, and $20 billion that you pay to them. But do we know the terms between you and Google? Now, here's what I found out. I have a good relationship with Tim. Of course, I know them. We're not revealing them. Laughter.
You found out very little, and it's an important relationship.
But they're making stuff up. They're making stuff up. They don't know any more than I do.
Gemini is going to power Siri for the AI.
Right. But I'm telling you, these people know no more than I do. And they're telling you that it's going to be really expensive. Wow. These are the people who told me that the tariff was going to wreck the numbers. I said, absolutely not. These are people who told me that China was going to be awful. I said, absolutely not. Now, I'm not saying I know more than they do. I'm saying they know less than I do.
Well, you should have just told everybody to buy SanDisk.
Which is up 23%.
Okay, SanDisk. I said it was going to 800.
I said it was going to 800
points. I said it was going to 800.
I mean, look at this thing.
It's going in a straight line to 800. You can't get to 800 without going through 600.
There it is.
There.
Oh my. Oh my. Oh my.
Well, SanDisk deserves it too. They've been laboring in the vineyard, the vineyards forever. And I'm talking about the Manischewitz.
No stopping demand for memory. Their CEO saying this is a completely demand-driven phenomenon. What's going on in the market? He says they've been transparent for well over a year. What their supply plans are. They're investing heavily in the market. What's happening is we're just not getting enough visibility into what the demand side is, what the demand really is.
David Gockler is a very conservative guy, and he is. We remember him in very rough times. By the way, he's paying down all that debt. He deserves it. This guy, it's his time. It's his time.
Yes.
It's Dave's time. Okay?
Got it.
All right. Let's go. You know what? Can we just skip tech for a while, Carl, and go to oil and gas? We need a good oil and gas man right now. Chevron delivering an earnings beat as production hit a record. Oil giant Chevron sees a lot of upside in Venezuela. Hey, Mike Wirth is the man who's in charge of Chevron. Mike, welcome back to the show.
Thank you, Jim. Good morning, everybody.
Good morning. Great quarter, raising quarterly dividend, output coming up. What do you think is driving your increase in output? Because I don't want to just pin it on Venezuela.
Well, 2025 was a record year for us, really, in growth, execution, and shareholder returns. Adjusted free cash flow was up 35%, even as oil prices were 15% lower. We set a production record worldwide. We set production records here in the U.S. We had our highest U.S. refinery throughput since the 1990s. And we returned a record $27 billion in cash to our shareholders. As you mentioned, we increased our dividend this week, 4%, the 39th year in a row that we've increased the dividend. And our shares yield about 3 times the S&P 500 in terms of the dividend yield. So we've got good organic growth. We've consolidated Hess for a portion of last year, started up a big project in Kazakhstan, continued to grow in the Permian, grow in the Gulf of America. We've got a broad, diversified portfolio that continues to deliver high-margin, low-cost growth.
Well, Mike, I think it's important for our viewers to know this is being done at a time when oil is not doing that well. Your numbers seem to have gotten in a way to have, I hesitate to do this, but I'm going to say it, more secular growth than the other oil companies that I see.
Well, we've certainly been focused on growing free cash flow. Some of that comes with volume, some of it comes with margin expansion. And as I mentioned, even in a period of declining oil prices, which we've seen over the last 12 months, we've been able to grow our free cash flow, which supports those distributions to shareholders. We're taking cost out of our business. We're becoming more efficient. We're only scratching the surface on what we can do with AI. I think that's the next leg of both efficiency and asset productivity we'll see in our business. So we're working across the entire portfolio to drive that growth in free cash flow.
I'm glad you mentioned AI, not just for what you're doing with it, but I know that you use the amazing natural gas numbers. Have any hyperscalers contacted you and just said, Mike, we need to take down a huge amount of your natural gas. Let's do a deal?
Well, we're certainly talking to all the hyperscalers about power supply. Absolutely. They're very interested in a project that we're developing in West Texas. We produce 3 billion cubic feet per day in the U.S., and we've got 7 of GE Vernova's largest turbines with secure delivery dates. We've got a site. We're into permitting, engineering, and we're in discussions with the biggest companies in the world, some of which you've already mentioned this morning, about a purpose-built energy park not connected to the grid, so it doesn't drive up prices for consumers, but scaled alongside of their data center growth to support their ambitions. So we're in contact with them later this year. We would expect to announce, a customer and more definitive details on this.
In 2026? Really?
Absolutely.
Soon?
First power in 2027.
Wow. Didn't know that. Okay, I just want to get to Venezuela before I go to my colleagues. I know that there are things called productive participation contracts in Venezuela, including one that literally just passed. It seems to be that they could make it so that they can tell you how much you're going to make, but it sounds like you'll be able to produce a little bit more. And under this, because you stayed down there, is there a possibility that you will be the most, like a Costastan deal? You'll be the guys. Because they're the ones you trust, they trust you, and you know how to do it, and you know how to do it without employees getting hurt.
Well, we've stayed when others didn't. We're getting paid back some debts that we're owed, and it does give us a significant head start, and the country has tremendous long-term potential. We've been there for most of the last 100 years, and it's got the potential to grow up to 50% over just the next 18 to 24 months. Our position does, on top of going from 50,000 barrels a day to 250,000 over just the last 2 years. We'll need some additional authorizations from the U.S. government in order to do so, but we see this as a valuable resource option for the future in our portfolio. And as you say, our focus remains on safe and reliable operations as always.
Mike, Rubio was on the Hill this week. A lot of discussion about security and whether or not the administration would put forward more military assets to maintain security. Do you consider it safe? I mean, the president this week said Americans will be able to visit soon. Do you see it as that kind of stable ground?
Yeah, Carl, we've been operating there for, through the last many years, and including when there's been concerns about military action and other things. We've got good, strong safety protocols and security protocols in place in the country. Our people are safe, and that's the first focus that we have. So yes, there are parts of the country that I would say are less safe. The areas where we operate, certainly we feel it's appropriate for us to have expatriate employees there as well as national employees, and our operations have continued uninterrupted through this entire period of time.
You know, I think, Mike, it's David, when people talk about security, though, they're also just talking about the security of my ability to operate in the country and not be nationalized again. I mean, yesterday, literally yesterday, the president there signed a law that opens the nation's oil sector to privatization. Is it your expectation that if you do make plans to invest a lot more capital, you're going to be able to get a return on that? Because in 10 years, that privatization will still be in place, or 15 years? How confident are you about that?
Well, this will evolve over time, I think, David. You know, we're still taking a look at this new hydrocarbon law that passed yesterday. Stability of government and the rule of law is very important for us anywhere in the world that we operate. We consider security, contract terms, the ability to get a return on our investment, commercial stability, regulatory predictability when we make investment decisions. And so like everywhere, those things matter. I think we see Venezuela taking steps in a positive direction to address those issues, which will encourage investment not only from a company like ours, but from others that I think are also considering the opportunities there.
Right. And yeah, when do you think you'll actually have a better sense for what that law really means? I mean, again, as you point out, just signed yesterday, but obviously seems to be an important moment for the country.
Well, I do think it's an important moment because they recognize that the terms there have made it difficult for companies like ours to invest there. Our position on the ground has been primarily focused on recovering debt that we're owed, and we've been successfully doing that. But the growth of the production in the country is going to require new capital and companies beyond ours to come in and do the same kind of a thing. And so I think that's what they're trying to address. It'll take us a little while to understand what's in the new bill. And then, of course, we're looking for other signs of economic reforms and progress and stability in government. And so all of these factor into our plans. We'll stay very disciplined on capital. We've got a global portfolio that we can invest in around the world, as we've been discussing earlier. And so Venezuela's opportunities will be stacked up against those others, and we'll have to deliver returns that are competitive.
All right, Mike, just quickly, Leviathan, final investment decision, 2.1 billion cubic feet off the coast of Israel. Where are you going to put that? Where's that going to go? You need a pipeline.
We just sanctioned a big project at Leviathan, which is offshore Israel. This is an area that's a world-class resource. We've got a platform, Leviathan and Tamar, both of which we're expanding already with production that'll come on later this year, and then a bigger expansion of Leviathan that comes on towards the end of the decade. This supplies the majority of the gas into Israel, a lot of gas into Jordan, and the growth will also supply Egypt, where some of this gas goes today, but a significant...
Ready for business with...
Good evening. Let's do it right with Nuvama presents The Wealth Brief, where today's market moves are decoded to guide your wealth journey. Market snaps 3-day winning streak as all major indices close in the red. Nifty falls below 25,350, with Hindalco, Tata Steel, Coal India, ONGC, and ICICI Bank among the top losers. Sensex drops 297 points to 82,270. Nifty down 98 points to 25,321. Nifty Bank falls 347 points to 59,610. And the mid-cap index slips 109 points to 58,432. Market breadth remains positive despite the decline, with advances outnumbering declines. Metal stocks underperform as the metal index slips and Hind Copper, Hind Zinc, and others fall up to 12%. In individual stocks, Swiggy falls over 5% as its net loss widens to 1,065 crore rupees, and CLSA downgrades the stock. South Indian Bank drops over 15% as its CEO does not seek reappointment. Ambuja Cements and MOIL declined 5% and 4% post-earnings. On the upside, Nestle gains 3% as the top Nifty gainer after strong Q3 results. Indoco Remedies rises 2% following US FDA approval for lacosamide oral solution, while Vodafone Idea jumps over 11%, emerging as the top mid-cap gainer. Investments in securities market are subject to market risks. Read all the related documents carefully before...
NATO must play a much stronger role in the Arctic region, in the High North, including in and around Greenland, something we have been actually requesting for a long time. But until NATO's Arctic Sentry mission is in place, participation in the ongoing exercise, as you were just talking about, Arctic Endurance, is very important. It has to be, of course, in close cooperation with all NATO allies. And I would like to underline that the quick and substantial French contribution has been highly appreciated from Greenland and Denmark. Finally, let me emphasize that in a situation where the world order as we have known it is under pressure, it's changing rapidly, maybe it's gone, then we need a stronger Europe than ever. A Europe that is willing and able to stand up for our values and for our principles. For me, the way forward is quite clear. It's up to us and only up to us Europeans to create a confident and prosperous Europe of tomorrow.
Our close cooperation in this.
Hello and welcome to India Business Hour. I'm Ashmit Kumar. Here are the headlines that we're tracking this evening. The US President Donald Trump picks Kevin Warsh as the next chairman of the Federal Reserve. 55-year-old Warsh is a former Fed governor who has aligned himself with the president. Criticism of the Fed. Trump has consistently bashed the Fed for not cutting rates faster. The prices of gold and silver plummet in trade due to profit booking after a frenzied rally in the last 13 months. Gold prices are up 100% since 2025 and silver prices are up a whopping 300%. Market regulator SEBI clears the decks for NSE to go public, issues a no objection certificate for the initial public offering. The IPO is expected to be launched by Diwali with a potential market capitalization of 5 lakh crore rupees. Government's fiscal deficit narrows in the first 9 months despite lower tax mop-up and higher capex share. Fiscal deficit from April to December stands at 54% of the full-year estimate. Reserve Bank's forex reserves hits a record high of $709 billion. Bajaj Auto reports a steady third quarter. Revenue rises by 20% and profits by 18% despite the Labour Code impact. FMCG major Nestle beats expectations with a 47% surge in profits and 19% rise in revenue. India's new inflation formula will lower the weightage given to food prices. Commodities will be regrouped based on consumption. Transport, housing, electricity and fuel will see higher weightage in the formula. Former policymakers list out their expectations from the union budget, expect overall capex hike to 5 to 6% range and 15 to 20% growth in defense budget. They also expect the share of government borrowings in the overall budget to come down. Former tax architects call for abolishing securities transaction tax ahead of the union budget, says it has outlived its purpose. Also call for rationalization the customs duty framework and slashing the number of slabs from 8 to 4. World Bank partners with the Indian government to support job creation in the private sector, announces annual financing of $8 to $10 billion over the next 5 years. Apple reports record quarterly revenue of $144 billion thanks to blowout iPhone sales. Company says India revenue has hit a record high with double-digit growth. US President Trump files a lawsuit against the US Treasury Department and tax authorities over the disclosure of his tax returns for 2019 and 2020. Seeks $10 billion in damages for causing significant harm to his reputation. Also on the show, India's 50,000 crore rupee shrimp industry remains rattled after US imposed 50% tariffs on exports. Shrimp farmers in Andhra Pradesh hope that the budget goes beyond usual duty cuts and provides specific relief for the industry. Well, the top story this evening, U.S. President Donald Trump has nominated former Fed Governor Kevin Warsh to succeed Jerome Powell as the Federal Reserve Chair when his term ends in the month of May. The 55-year-old, who has aligned himself with Trump's criticism of the Fed, was widely expected to replace Powell. Now, since Powell's confirmation in 2018, Trump has been pressurizing the Fed to cut rates aggressively. Steve Leisman is here with a profile of Kevin Warsh, Trump's nominee for the Fed's top job.
President, as you just said, announcing that former Fed Governor Kevin Warsh will be his pick for nominee. That concludes a months-long process. I believe we began back in the summertime. There's a picture of Kevin Warsh. He was, as you said, at the Duquesne family office partner going back to 2011, working with famed investor Stanley Druckenmiller, governor from 2006 to 2011, and a special assistant to George Bush in 2002 and 2008. He's been a sharp critic, as you know, of the Fed and Powell, blames them for the pandemic inflation. There you go. And he says the balance sheet can be, quote, reduced significantly. That's one of the concerns out there in the market. But he has said do that over time, and it would allow for rates to be reduced further. He has praised the pro-growth policies of championed by President Trump and said the Fed should abandon the dogma that growth creates inflation. I'm not sure the Fed has that dogma, but he says the Fed should abandon it. He supported the initial QE purchases of the Fed in the great financial crisis. Then he broke with Bernanke over subsequent QE purchases, in part because of his concern over inflation. That inflation didn't appear, and he's been criticized for that. He's concerned over inflation. One of the reasons why people think he's somewhat hawkish. He further argued that QE encouraged Congress to spend, leading to massive deficits out there. He thinks the Fed responsible for that. Now, on Fed independence, Warsh told us in July, quote, "I've strongly believed for 20 years, and history tells us that independent conduct of monetary policy is essential."
Now, gold prices have slipped after hitting record highs in the last session as investors booked profits. A stronger dollar also weighed on the prices. Despite this, the yellow metal remains on track for its strongest monthly performance in over 25 years, driven by safe haven demand. Bullion prices have more than doubled in the last 13 months. Silver prices, meanwhile, also fell sharply after scaling new peaks. However, the silver prices have quadrupled since the beginning of last year. Now to the market action. The Sensex and Nifty declined nearly 0.5% on Friday as the Lal Street awaits the union budget on Sunday. Sensex lost nearly 300 points, Nifty lost 100. Mid-cap index also declined, but the losses were limited. Bank stocks saw some sharp cuts, with the Nifty Bank index losing nearly 350 points. Despite this decline on Friday, Sensex and Nifty managed to end the week with gains of 1%. Mid-cap index gained by over 2% this week, and Nifty Bank also gained nearly 1%. Now, market regulator SEBI has cleared the decks for NSE to go public. The regulator has issued a no objection certificate for the initial public offering. Yash Jain is joining us now with more details. Yash, tell us, the long wait seems to be over. When can we expect the IPO to hit the markets?
Well, it's the start of that long wait getting over, not at the final point yet. That's because a market regulator, SEBI, today evening, of course, has given a no objection certificate or NOC to NSE's IPO. There is a lot of difference between NOC and the final approval for the launch of the IPO. NOC is just an approval for NSE to be able to file its DRHP with market regulator SEBI. Now NSE will file the DRHP with market regulator SEBI. That would be vetted by the market regulator, and an approval on that DRHP would finally allow NSE to launch its IPO and list itself. When does that happen? According to our sources, NSE is looking to file the DRHP with market regulator SEBI by April of this year and finally launch that big IPO by Diwali, that is the month of November in the current calendar year itself. What would be the size? According to my sources, the size could be about 2.5% according to the new SEBI regulations. Of course, the minimum dilution can be 2.5%, and that is what NSE could look at as far as that initial dilution itself is concerned. What is the valuation in the unlisted market? Shares of NSE trade at about 2,000 rupees a share. That gives the exchange a valuation of about 4.95 lakh crore rupees. As far as comparison of that valuation to other listed stock exchanges is concerned, NSE with a market cap of nearly 5 lakh crore rupees would trade at about 39 times FY27 estimated EPS. BSE, the listed stock exchange, trades at 43 times, MCX at 48.5 times, IEX at 25 times. How does NSE compare to global exchanges? It's one of the most expensive stock exchanges at a valuation of 5 lakh crore, trading, as I said, at about 39 times. NYSE trades at about 20 times. Hong Kong Stock Exchange is at about 28 times. London Stock Exchange at about 18 times. NASDAQ at about 22.8 times. Who are currently the biggest shareholders as far as the National Stock Exchange is concerned? The largest life insurance company, LIC, holds about 10.7% stake. Stock Holding Corporation at about 4.4% stake. SBI Capital at 4.3% stake. SBI at about 3.2% stake. GIC at 1.64%. And finally, Oriental Bank and New India Assurance at 1.42% stake, each holding in the National Stock Exchange. Interestingly, it is the largest unlisted company, the unlisted company with the largest retail shareholder base of about 1.7 lakh retail investors. As I said, that's the highest for any unlisted company so far. And some of the prominent names here include Rekha Jhunjhunwala, wife of late Rakesh Jhunjhunwala, R.K. Damani, Sachin Tendulkar, as well as Shah Rukh Khan.
Right, Yash, thanks a lot for those insights. Now, moving ahead to the money market, the rupee remained close to its record low against the dollar. The Indian currency ended the day just below the 91 mark against the greenback. The US dollar index has been hovering near a 4-year low, but that is not providing any help, any relief for the rupee as it continues to remain under pressure. Now, the Reserve Bank of India's foreign exchange reserves have hit a record high of $709 billion as of 23rd of January. This marks an $8 billion rise in just a week. The surge has been driven in part by higher gold prices. Total gold reserves are now at 11 lakh crore rupees. Foreign currency assets stand at $562 billion. Now, the central government's fiscal deficit has narrowed in the first 9 months of FY26 compared to the previous year. The deficit accounted for over 54% of the full-year budget estimate of over 8.5 lakh crore rupees. Now, capital expenditure was higher, reaching 70% of the full FY26 budget estimate in 9 months. Tax mop-up stood lower than the year-ago period at over 19 lakh crore rupees, or 68% of FY26 budget. Now, speaking of the budget, former policymakers expect the defense capex to receive top priority when Finance Minister Nirmala Sitharaman presents the union budget on Sunday. My colleague Shireen Bhan spoke exclusively to former budget architects at the Budget Vision. They told her that while defense capex may see a 15 to 20% hike, overall capex growth would remain in single digits.
So if you raise the total budget expenditure by 5 to 6%, and you have certain expenditures to take care in any case, like the interest, which grows at much more higher rate, and the Finance Commission recommendations would also be coming, which will require greater allocations for the state transfers, etc. In that situation, can you increase the capital expenditure as well as the other economic growth expenditure by a very large margin? I suspect that space is not there. So I would see that this, in my judgment, it will either be more or less at this level, or maybe a couple of percentage higher than that.
Okay, so single-digit increase is what you're anticipating as far as...
Lower single-digit.
Lower single-digit increase is what you're anticipating as...
The current year budget allocation is definitely going to be much higher than the previous years. And the growth in capex is definitely, in my understanding, going to be around 15 to 20%. And there is scope and potential to be a higher figure also.
Higher than 20%?
Yeah, because if the industry is ready, they are able to deliver what has already been ordered. The final expenditure outgo is going to be quite heavy, considering the type of platforms which are on order.
Now, former tax architects have called for abolishing securities transaction tax ahead of the union budget. They say it has outlived its purpose. They have also called for rationalizing the customs duty framework and slashing the number of slabs from 8 to 4.
I believe that the STT must go. It is high time it should go because, let me explain that. We brought it in 2004 as a substitute for long-term capital gains tax on equities. We reintroduced long-term capital gains tax on equity in 2018.
Yeah.
2 years back, we enhanced the rate of tax out there. Now, what we have is a situation where the long-term capital gains taxes are substantial, are fairly of a large amount. There doesn't seem to be any legitimacy remaining in continuing
STT.
with the STT any longer.
I think that is something that we can quite reasonably expect would happen in this budget. We are down to about 8 rates, not counting outliers. I mean, actually, there are outlying rates like 40, 70 and all, which I'm not taking into this reckoning. There would be moderation of rates. And my expectation is that the rates would come down to 4.
8 to 4.
8 to 4.
Now, personal income tax collections are expected to continue outpacing corporate tax receipts. According to the economic survey, income tax collections are set to touch 14 lakh crore rupees in FY26 against an estimate of nearly 11 lakh crore rupees from corporate taxes. Remember, income tax collections grew at a compounded annual growth rate of 22% in the last 3 fiscal years. This compared to 11% growth in corporate taxes. And coming up on India Business Hour, struggling with Trump's 50% tariffs, shrimp farmers from Andhra Pradesh are pinning their hopes on the union budget to provide some relief. A special report in just a bit. And you can also catch all CNBC TV 18's news and updates on YouTube, Facebook, Instagram, X and Jio Hotstar. Do subscribe to CNBC TV 18 Access for exclusive stories.
This is Network 18, and you're watching CNBC TV 18.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself.
You are watching India Business Hour. Now, India's new inflation formula will lower the weightage given to food prices. India's inflation calculation will see the base year shift from 2012 to 2024. Sapna Das joining us now with more details. Sapna, tell us, how will the new inflation math look going forward?
Well, the 2024 CPI series is basically a regrouping of commodities based on the purpose of consumption. Hence, 6 broad groups under the current CPI series, they have been reclassified into 12 divisions, and within that you will see a dramatic fall in the weightage of food. So food weightage is going to be under 35% as a category per se. Food and beverages together, the weightage is going to be less than 37%, and this is in stark contrast to the current weightage of 45.86% in the 2012 series. Now, analysts are very clearly indicating that this is going to help contain the kind of volatility that the CPI index has witnessed because of the spike or the change in prices of food. Food prices generally have been volatile. So to that extent, the new CPI series is going to be a better instrument of signaling both for Reserve Bank of India and also policymakers. Having said that, the mix in terms of the weightage to items is now more towards the urban side. So you will see the weightage for transport, housing, fuel, electricity, water, items of household maintenance, items of personal care, all of these, the weightages are going to go up. Also, e-commerce is going to be included in a big way, in the sense that the collection of price points from e-commerce sources, that's going to have a very heavy reflection in the entire CPI series. Last but not the least, also the transfer of free food grains. Well, this expert group has decided to leave that out from the new CPI series.
Right, Sapna, thanks so much for that. On to earnings now. Bajaj Auto posted a steady third quarter performance, which was in line with expectations. Net profit surged by 19%, while revenue also rose by 19% across the 15,000 crore rupee mark for the first time. Margins expanded 60 basis points, while EBITDA rose by 23% compared to last year. Revenues from Bajaj Auto's domestic business also hit a record, aided by festive demand and a sharp acceleration in electric vehicle volumes. And moving on, FMCG giant Nestle surpassed expectations on both the top and the bottom line in the third quarter. Net profit surged by 46%, aided by a one-time gain of 158 crores. Similarly, revenue, which was at a record high, grew at 18.5%. However, margins narrowed by 200 basis points due to an increase in advertising spends. A one-time expense due to the labor code impacted profits by 10 crore rupees. Now, Apple saw record quarterly revenue growth, and that's thanks to a blowout iPhone 17 sales. Top line rose by 16% as the iPhone generated $85 billion in revenue. The company's revenue rose from operations in India, also hit a record high, growing at double digits. Apple has projected revenue growth of 13 to 16% in the current quarter. Now, Andhra Pradesh, India's shrimp powerhouse, is staring at a trade shock that's rattled the entire supply chain, from export plants to farm ponds. CNBC TV 18 Shilpa Rani Petter travelled to the shrimp farms in Andhra Pradesh and reports that this time the hopes from the union budget is to go beyond just the usual duty cuts. Players want specific relief from Trump's 50% tariffs. Take a look.
December and Jan, it's like almost nil. From Feb and March, it's going to really hit very badly the industry.
Every day we have a different news from the US government regarding adding additional tariffs and corrections.
I have already suffered a loss of 10 lakh rupees.
Government sector nunchi,
there is no input from the government on how to go about things. Farmer, exporter, trader and hatchery. They are the only ones taking this industry forward.
ఈ నలుగురే ఈ ఇండస్ట్రీని తీసుకెళ్తున్నారు.
Andhra Pradesh is the heartbeat of India's marine industry, accounting for 80% of India's shrimp exports and 34% of marine exports.
The pond around me may look very calm, but it is at the center of a global trade storm. I am in Bhimavaram in Andhra Pradesh, a state that contributes 80% to India's shrimp export. Shrimp that travels from these ponds to dinner tables across the globe, sustaining a 50,000 crore economy here. But a 50% Trump tariff is now testing that global dependency.
The US is India's single largest shrimp market, and with effective tariffs on shrimp rising to 58%, Andhra Pradesh has the highest exposure to the trade volatility these tariffs have caused.
We do almost 70% of our revenue comes from US business. From the month of August, I've seen there's a huge fall of sales for US. Yeah, it's almost like I lost 20% business from US in the month of August. But as we see gradually from the month of December and Jan, it's like almost nil. Hardly 10% of our sales is for US right now.
Shipments that were locked into old contracts continued till the end of last year. But new orders have dried up, and processing plants that once ran at full tilt are now operating at a fraction of their capacity.
The crisis here is more than just the tariffs. It's also the hundreds of crores in retrospective tax that they have to pay, and also the thousands of containers that are stuck in the tariff trap.
Now, while the workers behind me continue to sort and grade, margins have hit a decade low for exporters, making every single gram of shrimp a financial gamble. The margins mean price cuts are impossible, and the high US tariffs have given competitors like Indonesia and Ecuador at 20 to 25% tariffs an edge. Shrimp farmers say tariffs are just the latest in a series of hits that began with the pandemic.
అది 2 years కంటిన్యూగా లాక్డౌన్ ప్రభావం చూపించింది. అది ఎక్స్పోర్ట్ లేకపోవడం, లాక్డౌన్లోనేమో మార్కెట్ లేకపోవడం.
There was no market during the pandemic, so we faced losses. Once that got better, we were hit by disease and that impacted the yield. It has been difficult for the past 6 months. I have already suffered a loss of almost 10 lakh rupees.
ఒక 6 months నుంచి కొంచెం ఇబ్బందిగా ఉండటం వల్ల 10 lakhs లాస్లోనే ఉంది.
There is no guarantee that you will get a good harvest anymore.
దాన్ని మనం చేతికి వచ్చేదాకా గ్యారంటీ లేదు ఇప్పుడు.
మెయిన్ ఈ వైరస్ తో ఎఫెక్ట్ అయిన ఫార్మర్స్ ఎక్కువ ఉన్నారు.
Farmers are impacted more by virus. Tariff is secondary. White spot disease has been terrible in 2025.
25 ఎండింగ్ జూన్ లో అయితే కనుక విపరీతంగా
Prices for 40 count shrimp have fallen from 380 to 340 rupees per kilo.
40 count. Now ఇప్పుడు 340, 350 కి వచ్చింది.
Experts say that while Andhra Pradesh has over 6 lakh acres of potential pond area, active shrimp cultivation has dropped to roughly 1 lakh acres as farmers move to fish farming for stability. But the state government says it has moved quickly to cushion the blow.
We have given almost 800 crores subsidy also given to the aquaculture farmers. 1 rupee 50 paisa was the unit rate. New markets opened in USSR, South Korea, Japan, and EU, especially the EU market, the UK market.
But exporters say no other market comes close to the US.
I don't think any other country in the world can give that price what we are getting from US. Countries like Japan or Vietnam or China, right? They are volume movers, but the price per unit of realization is very less.
Farmers and exporters add that temporary relief is not enough. While they hope for faster trade negotiations with the US, they are also looking to the union budget for extended working capital support and incentives for value-added processing to protect jobs and farmer incomes. In Bhimavaram, Andhra Pradesh, Shilpa Ranipeta.
Now, Ola Electric has announced a new restructuring exercise that will lead to layoffs of about 5% of its workforce. Ola currently employs more than 11,000 people, and the decision is likely to affect more than 500 jobs. Founder and CEO Bhavish Agarwal said that the company is doubling down on speed and discipline through increased automation and wants to build a leaner organization. Ola Electric has been steadily losing market share in the last few months. Incumbent players like Bajaj Auto and TVS Motor have gained market share at the expense of Ola Electric. And with that, it's a wrap on this edition of India Business Hour. Thank you so much for watching. News and updates will continue right here on CNBC TV 18.
With all
Good evening. Let's do it right with Nuvama presents The Wealth Brief, where today's market moves are decoded to guide your wealth journey. Market snaps 3-day winning streak as all major indices close in the red. Nifty falls below 25,350, with Hindalco, Tata Steel, Coal India, ONGC, and ICICI Bank among the top losers. Sensex drops 297 points to 82,270. Nifty down 98 points to 25,321. Nifty Bank falls 347 points to 59,610. And the mid-cap index slips 109 points to 58,432. Market breadth remains positive despite the decline, with advances outnumbering declines. Metal stocks underperform as the metal index slips and Hind copper, Hind zinc, and others fall up to 12%. In individual stocks, Swiggy falls over 5% as its net loss widens to 1,065 crore rupees and CLSA downgrades the stock. South Indian Bank drops over 15% as its CEO does not seek reappointment. Ambuja Cements and MOIL declined 5% and 4% post-earnings. On the upside, Nestle gains 3% as the top Nifty gainer after strong Q3 results. Indoco Remedies rises 2% following US FDA approval for lacosamide oral solution, while Vodafone Idea jumps over 11%, emerging as the top mid-cap gainer. Investments in securities market are subject to market risks. Read all the related documents carefully before. Good evening. Let's do it right with Nuvama presents The Wealth Brief, where today's market moves are decoded to guide your wealth journey. Market snaps 3-day winning streak as all major indices close in the red.
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV 18 and CNBCTV18.com.
At this juncture, my thinking is that the government might want to bring it down by at least 10-15 basis points even this financial year. I am basically saying that please don't cut it. Keep it at 4.4. If you were to just broadly look at the last 2 years, we've been doing sub 10% rate from a capex standpoint because in 2024 we actually didn't grow at all. So anything above 10 in my view is still respectable.
Well, despite a fall on Friday, Dalal Street closes the week with gains. The Sensex and the Nifty end the week over 1% higher, but the mid-cap index outperforms. Over the next 30 minutes, we'll decode the week on Dalal Street, decode the metals rally, and put the spotlight on US President Donald Trump's nomination for the Fed chair. Hello and welcome to Editors Roundtable. I'm Nigel D'Souza. Joining me are the editors Prashant Nair as well as Nimesh Shah. And also in the studio, we have Harish Krishnan, CIO, Aditya Birla, Sun Life AMC, who joins in. Hi, gentlemen. Good to have all of you here. It's not the end of the week that we know, because you've got a working Sunday. And I'm sure Prashant is excited about it.
It's a continuing working week, right? It never ends, right?
Yeah.
It's, I think many of us perhaps are working in this office tomorrow, and they will sort of continue to work on Sunday as well. But Harish, welcome to the program. Markets recovered a little bit, I guess, this week, right? I mean, about 1% on the Nifty, mid caps, small caps, perhaps a little bit more. But how's it looking? And can the budget? And don't start with, budget has lost its relevance. Start with what you think. Do you think it can do something? What's your sense?
Okay, so let's talk about budget and budget expectations, right? So I think there are 2 or 3 broad areas where they can provide some kind of support. One is in terms of, say, continuing to maintain their 4th gear on capex, because they've done all the heavy lifting from 2019 to 2024. I don't think they should expect meaningful fireworks, but even keeping the pedal on that and maintaining that itself is, I think, a good job, right? Would like to see if there is something on consumption more, because that seems to be the easier win today, because inflation is low. You can actually give something more to the consumer, because with that demand coming back, private capex can hopefully get their act going. And therefore, rather than relying on export as a channel, etc., I would think that consumption could be an area where they can double down on. Maybe something on credit guarantee for exporters as a whole, because a lot of heavy lifting is being done by the rupee today. Can there be something for the exporters over there? And then lastly, I think developing the bond market. This seems to be very high on the chatter that there could be something from a taxation point of view on the debt side. Now, whether that means an equalizer, whether it could be negative equities.
Harish has left out the one thing which we want to talk about, right, which is equity taxation. Let me tell you, yesterday I met a large private bank CEO. He said, in Hindi, he said, equity वालों को लगता है कि market नहीं चला तो life में यही problem है और कोई problem नहीं है government को. But obviously that is not the case. But it was his. It's not the pro or the. I mean, whether it should happen, not happen, and there are so many ways to debate it. But what's your sense? I mean, do you think the government will give this a relook?
I really doubt it. We would, of course, welcome it if they do anything on that count. But I would think that they would want to maintain status quo over there. Like I said, I would think that the priority needs to be on deepening the bond yield, because there is a lot of, lost in translation happening. The RBI has cut significant rates. Transmission has been very low. Okay, and possibly it is because that there is too much of supply of paper and not enough demand. And therefore, can there be a way to get that coming into fixed income? Could be one way out. So over the course of the last 2-3 years, I think taxation has been a bit regressive on the fixed income side. Maybe they can do something to kind of...
You mean lower fixed income taxation to bring it in line with equity?
I don't know, but maybe...
That is more likely than doing something for equity, in
I
your
would
view.
think so. That is something that we think could possibly happen.
Okay, first of all, congratulations being elevated as the CIO of Aditya Birla AMC. And coincidentally, only this week we saw a double upgrade from Citi. So I guess you are a lucky charm for the AMC.
Harish was always the CIO.
He was the co-CIO, now he's the CIO.
Congratulations,
So,
Harish.
Thank you.
He's going to head it now. How are you going to approach the next 1 year or next 12 months from now on? Mid-cap, large cap, small cap? How are you going to change the strategy at AMC?
Okay. So slightly more nuanced take than just going down on this market cap curve. See, the way we think about it is that we've seen a reboot moment in the last 12-15 months. There's not been business as usual. We've had geopolitical tensions, we have got trade tariffs. And for that reboot moment, the policymakers have also chosen new tools, which include, say, a focus on domestic consumption, a focus on rate cuts, and a focus to bring back growth rather than macro stability. So that's been the shift that policymakers have taken. Now, in this context, I think what we need as investors is to frame the opportunity set differently than necessarily look at the winners of the last cycle, right? And that really is the bigger theme that we have, which is that which are the areas which have kind of underperformed over the course of the last 3-5 years, okay? And there are quite a few of them. There are 7, 8, 9 sectors. Now, I'm not saying that, just because they have underperformed, they'll end up being on the winning side. But within these, there are now enough pockets which we think are providing values, right? So if you think of, say, consumer durables or even consumer retailing, there are so many companies, and we are talking about consumption, right? Which is throwing a lot of cash flows, which is asset light. And, what we are seeing is almost 4 to 5% free cash flow yield companies where the promoters own 60, 70, 75%.
Yeah.
Okay. Now, today there is a reset wherein foreign investors are selling out, etc., which provides us, therefore, a great opportunity to look into that. So we are not negative small caps. All we are saying is we need to look at different names of small caps rather than looking at it from the lens of the investment names of, say, the EMS or the hospital names, etc., which have all got great stories and they've got some credible stories out there. But I think the appreciation of those stories have gone significantly over the last 3-5 years, which possibly will need to take a breather out there. So that is the nuance that we are talking about.
We're going to talk about metals in two ways. We're going to talk about why metals had a fantastic run this week, and then Nigel will talk about that, and then why they're correcting today. So we'll split it. Nigel, you go first.
Well, metals are on fire. The problem is it getting too hot for comfort? Because, the way the metal stocks have been running up, it's just been one way. In the month itself, we're making 20-25% on all these metal stocks. In fact, everyone has participated. What's driving the metal rally? Well, that dollar index has been weak, which is normally positive for, for metal prices. You have a bit of a scarcity that's taking place out there. To give you an example, on copper, you have a global capacity of around 28 million tons, already at around 23-24 million tons. So the street believes that, given the kind of demand that's going to be there from the copper segment, there could be a shortfall for the next few years. On aluminium, China is always the play, right? What will China do next? Now, last year, they already produced 43.5 million tons approximately. They've capped their capacity around 45 million tons. So there's only so much of headroom. So that's why the street believes that maybe, in fact, that as well can be a tailwind from here on. Otherwise, you're talking about EVs, you're talking about, the electrification drive that's taking place globally as well. And that's what's boosting demand. So all that is taken into play. The question is, valuations are way above averages. As we know, metals move with momentum. Fundamentals actually take a bit of a backseat. Just to give an example, Harish, if I look at Hindustan Copper, last year they did a PAT of around 500 crores. Now, given that copper prices have moved up to such an extent, there's an Anand Rathi note that said that maybe they could do 2,000 crores odd in FY28. Now, going by the surge they've seen, maybe they do 3,000 crores as well. But it's at 75,000 crores of market capitalization before falling today. So, how do you justify a miner at around 20-25 times odd? What is your take on the metals pack? Do you think it's had its, time in the sun? And also, I want to ask you this other question that we have been talking about a few times. The equities versus gold. So far, gold has been outperforming. But it appears now it's time when gold is getting wibbly-wobbly, which is good actually from an equity market perspective. Your take.
Sure. So we had metals as one of the dark horse sectors to look at last year. Okay. And just to give you a sense as to why we chose that as a pack, because none of this what we knew eventually happened, did we know at that point of time. See, what we look for in a cyclical sector is to buy when profit pool share is very, very low. Just to give you a sense, the profit pool share of metals varies from 2% to 17%. It's a very wide band. And at that point of time, the profit pool share of metals was at 2%, which was the lowest in 25 years. And therefore, we believe that, okay, here is a prospect that it can possibly reverse over a period of time due to X number of other reasons, right? As we stand today, a lot of the profit pool share growth has come through. And generally, we say that, when the worst run miner or the worst run company starts making record profits, that's invariably the time to kind of unwind the trade. And when the best run company makes losses, that is when, you want to completely go hammer in over that trade. So I think we are somewhere in the middle. I won't say that, we are at the absolute peak. Okay, because there still is some kind of element. But are we rushing to deploy more capital in metals as a space? The answer is definitely no. We're letting whatever we own continue to run over a period of time. Coming to gold, now this is something which is obviously been on a tear, silver even more so. It was kind of surprising to me, we look at markets day in and day out, but I was kind of surprised that if you look at the last 12 months, and if you look at Nifty in gold terms, it is down 44%, okay? In 2008, Nifty was down 55 or 56% against gold. So it is not a small amount of correction that we are talking about. Even if I look at, say, US, which has continued to hold its water, okay? The last 12-month performance of S&P 500 in gold terms is actually the 4th worst in the last 30 years. So we have taken some serious damage in nominal terms and equity terms, okay? And that's courtesy a whole range of unconventional kind of policies that are happening. But the question is, these policies are not going to last forever, okay? It's very hard to time it. But more importantly, when you're looking at from a margin of safety and looking at Nifty in gold terms, this is absolutely one of the best places to be in. So we continue to believe that, this is as good a moment to deploy into equities compared to asset classes like gold and silver.
By the way, the bulls would argue, and they do argue, that if you look at commodities and say you go back all the way, like 40 years, 45 years, 1970, for example, and make the base 100, compare gold, or actually not gold, say take a commodities index, take the Bloomberg Commodity Index, and then look at that and look at the S&P 500 or look at something. I mean, commodities are still ultra cheap.
Absolutely.
Right? I mean, what you say is absolutely right. I mean, but slightly longer term, there are both ways to kind of argue this.
I completely reconcile to the fact that commodities or industrial commodities continue to remain cheap compared to, equities, okay, from a longer term range point of view. But when it comes to precious metals, they seem to be in another planet altogether, right? Because it's just not industrial activity that's driving it. It's a whole lot of 100%. Other things. Actually, so I'm saying only on
you track macros quite closely, global macros, etc., quite closely as well. And, very quickly in a minute, I want to just highlight. So profit booking, gold, by the way, is as we speak down about 6-7%. Silver is down 16-17%. And there is profit booking, but I think there is one more thing. And if you'll just put the graphics up, you'll see what I'm talking about. And, across the board, profit booking is what we're seeing. Spot prices, I'm talking about international prices, Here in MCX also prices are down. And on the other hand, if you look at the macro screen, dollar index is up, 10-year yields are up, and the S&P futures, I mean, the last I checked was down 40 points, it's about 1% or so. The reason, apart from profit booking, is that the market seems to be convinced that the next Fed chair, at least President Trump's nominee for the next Fed chair is Kevin Warsh. He was the Fed governor appointed by President Bush back in 2006. He's not a Trump insider, but of course he's agreed with Trump's policies, basic idea being to lower interest rates. Now the thing is, the way, I mean, actually it's a two-horse race, but the way both the candidates want to lower interest rates is very different. Kevin Warsh, and Polymarket, by the way, is now saying is the chances of him being the nominee, and the announcement is later tonight, is 95%. So let's go with that, right? His view, Kevin Warsh's view, is that, and I'm giving you the synopsis of it. He says, well, there's no need for the Fed to have a balance sheet. It should get out of the market making business or interfering in the market business. So he wants to reduce the size of the balance sheet. As I said, it's just a synopsis, and in terms of what I'm saying, he wants interest rates to be lower, 100%, no doubt. But so does the other guy. But I mean, the approach differs for both. And I think this is also one reason why international, I mean, if you look at commodities, etc., started selling off once. And this happened, when we were trading, started about 10:30, 11:30 or so. And that is accelerated as we go into US market open, etc. I mean, it's been, macro markets in that sense, right? I mean, catching big trends and doing that. Any thoughts on this, implications whatsoever?
Sure. So, see, at least the way we think about it is the time to look at macro is when nobody is discussing it. Now there is an overdose of it. So, quite honestly, even though I am a macro watcher, I would rather want to spend more time meeting companies. I want to go micro today, meet the best managements, back them up. Because, see, whatever is known is all out in the open. It is not that there can be any significant edge that I may have, other than predicting what I think can happen, which case everybody has got only such an edge, right?
And in terms of macro, your call is that gold, silver is kind of, now you won't put more money behind in that sense, right? So that is one. Now on this meeting company thing, right? When you look at stocks, etc., many stocks you'd find run screens down 40-50%. And they look tempting. But then you also see that earnings expectations have fallen quite sharply. I'm sure you read that note by Sanjeev Prasad of Kotak, who says, well, this could be, we'll have to see. It's a thoughtful note, whether this is if this is the a permanent kind of reset in valuations which is underway, or this is temporary. We had Venu Gopal, I don't know, of Bernstein this morning on the air, and he said, well, he doesn't think so. As long as domestic money is coming in, mutual funds have to deploy, so there is unlikely to be any large corrections. I don't know if you have a view.
See, in my view, value lies in scarcity, okay? Whichever company is becoming more and more scarce, that is where value will eventually migrate to. So all of these notions that, a price to earning has to be at 10 or 20 or 30, and don't take me as someone who is price agnostic or value agnostic. But I'm just saying that if there is a company which is kind of thinking from first principles and doing things very differently from the rest of the pack, despite the same environment, okay, it is very hard to say that the bound or the upper bound of the value should be there, okay? So, but I take into cognizance that how many such good companies are there in the market, right? Ultimately, it all boils down to that. Can we find few exceptional companies and can they valuations go up quite significantly? Absolutely, yes. But what we are today finding is, close to about 35% of companies are trading at an earnings yield of 2%, which means that are they really that exceptional? I don't think so. So yes, there is going to be a lot of the froth letting out still left, okay? But in that milieu, can we find out names which are also getting thrown with the rest of the bathwater? And that is where, we want to deploy most of our time.
And this will play out in the coming months.
And this will play out over time. It's not going to play out in the next 3 months, 6 months. But we think that those opportunities are what we want to track and we want to deploy time.
Let's take a break here. Have to do that. We'll come right back, continue the conversation.
Time. This is Network 18, and you're watching CNBC TV 18.
Certain tweaks, especially around LTCG, is probably warranted. It's not a very large quantum, especially the equity side of things. Probably government could have bands a couple of years down the line. So if you have more than 3-year hold or 4-year hold, maybe have the differential, taxes. I'm not expecting too much on consumption side of things. We've done a lot of things last year, and remember that GST impact of low collections will also be felt in this upcoming financial year as well.
Welcome back. You're with us here on Editors Roundtable. Harish Krishnan is with us. Harish, point us in the right direction as much as you can. Where are these? You said, well, opportunities will emerge as this cleansing process happens. Valuations are still high, but you can find something, one or two, or maybe more names in each sector. So just how to, I mean, if you can do it, how would you recommend viewers do it? I mean, it'd be great if you could name names, but I think you'd be hesitant. So.
No, so see, the way we see it is, what are the kind of unloved places that are there, okay? Today, these are the names which, are the ones where promoters are either increasing stake or where they are already at the fill, which is at 70, 75%, right? They're throwing significant amount of cash flows. Yes, near-term growth construct is bad, okay? But, they are available at anywhere between 3 to 5% free cash flow yields, okay? Which means that there is reasonable margin of safety that one is getting into. Yes, nobody knows how the next 2 quarters is going to go by. Maybe there will be more downgrades in many of these names. Many of them have got impacted by tariffs. Many of them have got impacted by new competition. So the narratives are keeping on shifting. But we are seeing a massive cap table reset, okay? Because these are the names that were loved pre-COVID. Lot of foreigners used to own a lot of stakes in these names. And for whatever reason, they are now compelled to kind of exit these names, which means that these are stocks which are down 50, 60, 70% from their highs. Okay. And when you get these kind of full tosses, in my opinion, we should hit it for a 6. We shouldn't kind of then bat, and hope for a single. So at least that is the way we are kind of...
Give us 3 balls at least for full tosses. I think
no, so like I said, on durables, we are finding a lot of... other way to look at it, I'm just saying. There were many names which used to trade at, say, 5, 6, 7, 8 times price to sales.
Yeah.
Today, they are trading at 2.5 times price to sales. Whereas their B2B counterparts in that same space, which used to trade at less than 1 time sales pre-COVID, today is trading at 5 times sales. Now, at 2.5 times sales, these, to my mind, very well governed franchises.
And these are consumer facing.
These are consumer facing.
Not the B2B ones.
No, these are B2C facing.
Yeah.
Yes, today the impetus may not be there, but that is where we are hoping that, greater focus on the domestic demand. A lot of things can work through. That is one approach. The second approach could be where supply is actually kind of vacating. So if you look at, say, I'm just giving an example of a sector like, say, insurance. 5 years back, everybody wanted to start an insurance company. Today, if you were to look at it, there is consolidation all over the place. The big 3, big 4 are taking more and more share. Right, and therefore, yes, while there is a near-term issue of whether regulator is going to allow for commission pools, this, that, and the other, and yes, this is going to impact everyone within that space. But the bigger guys are going to become even more bigger, and that is where we think that the appreciation of those franchises will go up even more compared to what is there before. Right. If I were to think of even, say, IT services, okay, under ignored area, okay. Over here, we are seeing some companies transitioning very, very quickly and saying that we want to be a product-like company in some aspect. Okay, we are seeing SaaS now. SaaS globally is completely in doldrums. Okay, but for us in India, SaaS is possibly an emerging frontier because in India, SaaS companies didn't have a home market to sell into. Today, we are seeing companies having to spend on all of these things, be it in fintechs, be it in various service offerings. So I think that the nature of the opportunity set is very, very different. Same with even new age companies. I know there is a lot of heat against new age companies that, they've become so large, so much value is being created, very little cash flows, etc. But it might surprise you that if you look at the market cap share of loss-making companies, today it is at 1.7% of total top 1,000 companies is in loss-making companies, the total market cap share. Historically, if you look at the last 25 years, this number used to oscillate anywhere between 4 to 6%. Okay, and what is the loss-making companies that the market used to support at that point of time? It would be either PSU, it used to be trading companies, it used to be companies which had acquired some assets overseas and then went into difficulties. Basically, end of life or mature companies which had their own struggle to get back to profitability. These are very early stage companies, okay, with a path to unit economics and profitability. At total 1.7% of market cap, is it something that we should be very worried about? I don't think so. I'm not saying that, between a profitable company and a loss-making company.
That's not the choice. But
that's not the choice. Yeah. But then, does it make sense to back some of these companies in this carnage? I definitely do think that, rather than trying to protect the next 3-6 months and see how things can be, look at playing on the front foot for the next 3 years, 5 years. And that is where I think wealth can be created.
I think fantastic ways to think about, constructs you've given us. I hope we could continue this conversation longer, but I think, Nigel, we're running up against time.
Thanks a lot, Harish, for joining in, and thanks, gentlemen. Well, we'll wrap on this edition of Editors Roundtable. You stay tuned to CNBC TV 18. More news and updates coming up on the other side. Thanks a lot for watching.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship.
Young Turks at 22. Only on CNBC TV 18 and CNBCTV18.com.
CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV 18 weeknights at 7 p.m. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV 18 and CNBCTV18.com.
At this juncture, my thinking is that the government might want to bring it down by at least 10-15 basis points even this financial year. I am basically saying that please don't cut it. Keep it. Certain tweaks, especially around LTCG, is probably warranted. It's not a very large quantum, especially the equity side of things. Probably government could have bands a couple of years down the line. So if you have more than 3-year hold or 4-year hold, maybe have the differential, taxes. I'm not expecting too much on consumption side of things. We've done a lot of things last year, and remember that GST impact of low collections will also be felt in this upcoming financial year as well.
Hello and welcome to India Business Hour. I'm Ashmit Kumar. Here are the headlines that we're tracking this evening. The US President Donald Trump picks Kevin Warsh as the next chairman of the Federal Reserve. 55-year-old Warsh is a former Fed governor who has aligned himself with the president. Criticism of the Fed. Trump has consistently bashed the Fed for not cutting rates faster. The prices of gold and silver plummet in trade due to profit booking after a frenzied rally in the last 13 months. Gold prices are up 100% since 2025 and silver prices are up a whopping 300%. Market regulator SEBI clears the decks for NSE to go public, issues a no objection certificate for the initial public offering. The IPO is expected to be launched by Diwali with a potential market capitalization of 5 lakh crore rupees. Government's fiscal deficit narrows in the first 9 months despite lower tax mop-up and higher capex share. Fiscal deficit from April to December stands at 54% of the full-year estimate. Reserve Bank's forex reserves hits a record high of $709 billion. Bajaj Auto reports a steady third quarter. Revenue rises by 20% and profits by 18% despite the labor code impact. FMCG major Nestle beats expectations with a 47% surge in profits and 19% rise in revenue. India's new inflation formula will lower the weightage given to food prices. Commodities will be regrouped based on consumption. Transport, housing, electricity and fuel will see higher weightage in the formula. Former policymakers list out their expectations from the union budget, expect overall capex hike to 5 to 6% range and 15 to 20% growth in defense budget. They also expect the share of government borrowings in the overall budget to come down. Former tax architects call for abolishing securities transaction tax ahead of the union budget, says it has outlived its purpose. Also call for rationalization the customs duty framework and slashing the number of slabs from 8 to 4. World Bank partners with the Indian government to support job creation in the private sector, announces annual financing of $8 to $10 billion over the next 5 years. Apple reports record quarterly revenue of $144 billion thanks to blowout iPhone sales. Company says India revenue has hit a record high with double-digit growth. U.S. President Trump files a lawsuit against the U.S. Treasury Department and tax authorities over the disclosure of his tax returns for 2019 and 2020. Seeks $10 billion in damages for causing significant harm to his reputation. Also on the show, India's 50,000 crore rupee shrimp industry remains rattled after U.S. imposed 50% tariffs on exports. Shrimp farmers in Andhra Pradesh hope that the budget goes beyond usual duty cuts and provides specific relief for the industry. Well, the top story this evening, U.S. President Donald Trump has nominated former Fed Governor Kevin Warsh to succeed Jerome Powell as the Federal Reserve Chair when his term ends in the month of May. The 55-year-old, who has aligned himself with Trump's criticism of the Fed, was widely expected to replace Powell. Now, since Powell's confirmation in 2018, Trump has been pressurizing the Fed to cut rates aggressively. Steve Leisman is here with a profile of Kevin Warsh, Trump's nominee for the Fed's top job.
President, as you just said, announcing that former Fed Governor Kevin Warsh will be his pick for nominee. That concludes a months-long process. I began back in the summertime. There's a picture of Kevin Warsh. He was, as you said, a Duquesne family office partner going back to 2011, working with famed investor Stanley Druckenmiller, governor from 2006 to 2011, and a special assistant to George Bush in 2002 and 2008. He's been a sharp critic, as you know, of the Fed and Powell, blames them for the pandemic inflation. There you go. And he says the balance sheet can be, quote, reduced significantly. That's one of the concerns out there in the market. But he has said do that over time, and it would allow for rates to be reduced further. He has praised the pro-growth policies of championed by President Trump and said the Fed should abandon the dogma that growth creates inflation. I'm not sure the Fed has that dogma, but he says the Fed should abandon it. He supported the initial QE purchases of the Fed in the great financial crisis. Then he broke with Bernanke over subsequent QE purchases, in part because of his concern over inflation. That inflation didn't appear, and he's been criticized for that. His concern over inflation, one of the reasons why people think he's somewhat hawkish. He further argued that QE encouraged Congress to spend, leading to massive deficits out there. He thinks the Fed responsible for that. Now, on Fed independence, Warsh told us in July, quote, "I've strongly believed for 20 years, and history tells us, that independent conduct of monetary policy is essential."
Now, gold prices have slipped after hitting record highs in the last session as investors booked profits. A stronger dollar also weighed on the prices. Despite this, the yellow metal remains on track for its strongest monthly performance in over 25 years, driven by safe haven demand. Bullion prices have more than doubled in the last 13 months. Silver prices, meanwhile, also fell sharply after scaling new peaks. However, the silver prices have quadrupled since the beginning of last year. Now to the market action. The Sensex and Nifty declined nearly 0.5% on Friday as the Lal Street awaits the union budget on Sunday. Sensex lost nearly 300 points, Nifty lost 100. Mid-cap index also declined, but the losses were limited. Bank stocks saw some sharp cuts, with the Nifty Bank index losing nearly 350 points. Despite this decline on Friday, Sensex and Nifty managed to end the week with gains of 1%. Mid-cap index gained by over 2% this week, and Nifty Bank also gained nearly 1%. Now, market regulator SEBI has cleared the decks for NSE to go public. The regulator has issued a no objection certificate for the initial public offering. Yash Jain is joining us now with more details. Yash, tell us, the long wait seems to be over. When can we expect the IPO to hit the markets?
Well, it's the start of that long wait getting over, not at the final point yet. That's because a market regulator, SEBI, today evening, of course, has given a no objection certificate or NOC to NSE's IPO. There is a lot of difference between NOC and the final approval for the launch of the IPO. NOC is just an approval for NSE to be able to file its DRHP with market regulator SEBI. Now NSE will file the DRHP with market regulator SEBI. That would be vetted by the market regulator, and an approval on that DRHP would finally allow NSE to launch its IPO and list itself. When does that happen? According to our sources, NSE is looking to file the DRHP with market regulator SEBI by April of this year and finally launch that big IPO by Diwali, that is the month of November in the current calendar year itself. What would be the size? According to my sources, the size could be about 2.5% according to the new SEBI regulations. Of course, the minimum dilution can be 2.5%, and that is what NSE could look at as far as that initial dilution itself is concerned. What is the valuation in the unlisted market? Shares of NSE trade at about 2,000 rupees a share. That gives the exchange a valuation of about 4.95 lakh crore rupees. As far as comparison of that valuation to other listed stock exchanges is concerned, NSE with a market cap of nearly 5 lakh crore rupees would trade at about 39 times FY27 estimated EPS. BSE, the listed stock exchange, trades at 43 times, MCX at 48.5 times, IEX at 25 times. How does NSE compare to global exchanges? It's one of the most expensive stock exchanges at a valuation of 5 lakh crore, trading, as I said, at about 39 times. NYSE trades at about 20 times. Hong Kong Stock Exchange is at about 28 times. London Stock Exchange at about 18 times. NASDAQ at about 22.8 times. Who are currently the biggest shareholders as far as the National Stock Exchange is concerned? The largest life insurance company, LIC, holds about 10.7% stake. Stock Holding Corporation at about 4.4% stake. SBI Capital at 4.3% stake. SBI at about 3.2% stake. GIC at 1.64%. And finally, Oriental Bank and New India Assurance at 1.42% stake, each holding in the National Stock Exchange. Interestingly, it is the largest unlisted company, the unlisted company with the largest retail shareholder base of about 1.7 lakh retail investors. As I said, that's the highest for any unlisted company so far. And some of the prominent names here include Rekha Jhunjhunwala, wife of late Rakesh Jhunjhunwala, R.K. Damani, Sachin Tendulkar, as well as Shah Rukh Khan.
Right, Yash, thanks a lot for those insights. Now, moving ahead to the money market, the rupee remained close to its record low against the dollar. The Indian currency ended the day just below the 91 mark against the greenback. The US dollar index has been hovering near a 4-year low, but that is not providing any help, any relief for the rupee as it continues to remain under pressure. Now, the Reserve Bank of India's foreign exchange reserves have hit a record high of $709 billion as of 23rd of January. This marks an $8 billion rise in just a week. The surge has been driven in part by higher gold prices. Total gold reserves are now at 11 lakh crore rupees. Foreign currency assets stand at $562 billion. Now, the central government's fiscal deficit has narrowed in the first 9 months of FY26 compared to the previous year. The deficit accounted for over 54% of the full-year budget estimate of over 8.5 lakh crore rupees. Now, capital expenditure was higher, reaching 70% of the full FY26 budget estimate in 9 months. Tax mop-up stood lower than the year-ago period at over 19 lakh crore rupees, or 68% of FY26 budget. Now, speaking of the budget, former policymakers expect the defense capex to receive top priority when Finance Minister Nirmala Sitharaman presents the union budget on Sunday. My colleague Shireen Bhan spoke exclusively to former budget architects at the Budget Vision. They told her that while defense capex may see a 15 to 20% hike, overall capex growth would remain in single digits.
So if you raise the total budget expenditure by 5 to 6%, and you have certain expenditures to take care in any case, like the interest, which grows at much more higher rate, and the Finance Commission recommendations would also be coming, which will require greater allocations for the state transfers, etc. In that situation, can you increase the capital expenditure as well as the other economic growth expenditure by a very large margin? I suspect that space is not there. So I would see that this, in my judgment, it will either be more or less at this level, or maybe a couple of percentage higher than that.
Okay, so single-digit increase is what you're anticipating as far
Lower
as...
single-digit.
Lower single-digit increase is what you're anticipating as...
The current year budget allocation is definitely going to be much higher than the previous years. And the growth in CapEx is definitely, in my understanding, going to be around 15 to 20%. And there is scope and potential to be a higher figure also.
Higher
However,
than 20%?
Yeah, because if the industry is ready, they are able to deliver what has already been ordered, the final expenditure outgo is going to be quite heavy.